And these are the top stories. Negotiators inch closer to a deal on raising the debt ceiling, said to include capping federal spending for 2 years. Cathie Wood's flagship ARK fund dumped Nvidia stock right before the chipmaker's blistering $560 billion rally. Ouch. Plus, tech stocks propel Asia markets higher, even as US futures stall before key US inflation data today. 2-year Treasury yields snap 10 days of gains. Let's check in on these markets then. Futures pointing higher in Europe, gains of 0.4%. The blistering AI-powered rally yesterday really focused on the Nasdaq, closing up with gains of around 2.5%. The S&P also ended higher by about 0.8%. The DAX futures are pointing to gains of 0.3%, and the FTSE is also flagged higher. Some retail sales data coming out slightly more robustly out of the UK. The FTSE 100 currently flat. Let's give it a few seconds to reflect the pricing. Suddenly showing gains of 0.2% this Friday morning. Over in Spain, the Spanish index adding 13 basis points just in the first few seconds, gaining about 0.1%. Stateside, of course, we are looking ahead to that PCE indicator in terms of the inflationary impulse out of the US. That is now as traders price in a full 25 basis points coming through in the next 2 meetings, June and July, from the Fed. So much for that pause. And of course, the claims data, the jobs claims data, came in, was revised lower. So lower and smaller jobs claims data, again, pointing to the robustness of the US labour market and the tightness that remains. The FTSE 100 now posting gains of 0.4%. Over in France, gains of 29 points. And in Germany, the DAX up 0.3%. Let's flip the board and reflect on what's been happening in the Treasury space in particular, because the run-up in yields that you've seen over the last 10 days, in fact, the last 30 days, you've seen about 80 basis points move higher in terms of yields at the front end of the US Treasury curve just in the last month. You're now above 450. Yields just edging down by 1 basis point today, but above 450 on the 2-year, again, as we reprice the next steps from the Fed. Euro-dollar 107 flat. Futures in the US flat as well after the gains of yesterday. Maybe a little bit of profit taking coming through. The debt ceiling conversations continue. Goldman Sachs saying the chances are if a deal's going to come through, it's likely at least to be agreed, if not inked, today, on Friday. Brent currently trading $76 per hour, gaining 0.2% after the losses of yesterday. Let's get to the politics of DC then. House Speaker Kevin McCarthy says negotiations are still looking, of course, at having those conversations. Negotiators covering before reaching an agreement to avert a US debt default. Meanwhile, the amount of money the government has to pay its bills tumbled to the lowest since 2021. Joining me now is Bloomberg's Bill Ferries for the latest on this. Bill, how close, we seem to be asking this on a daily basis, how close are we to finally getting a deal? Goldman Sachs, it could be today. Is that what you're thinking?
Well, you know, it's hard to be overly optimistic given what we've seen over the past couple weeks of these talks, but there is some optimism that the two sides could reach a deal as soon as later today, later on Friday in Washington. That would mean lawmakers would potentially be voting on an increase in the debt ceiling by Tuesday after they get back from the U.S. holiday weekend, and all that means is that you get ahead of the June 1st X date that Secretary Yellen has been warning about for weeks now.
There's an argument that there's been so much focus on the actual debate and the negotiations that maybe the spending caps part of this mix is being overlooked in terms of the broader economic impact. What do we know about the assessment going forward if you do indeed get 2 years of capped spending?
Right. As you said, we believe that they're talking about a 2-year cap. At one point, Republicans were pushing for a 10-year cap, so that has come down significantly. But there is going to be a lot of looking at the details of this by economists in the market to figure out whether these spending caps are severe enough to potentially push the U.S. Into recession, or if there is a recession, push it deeper into recession, and whether this will have some impact as well on the Fed rate decisions. So that's going to be something. We still don't have the details of where these caps are going to be set, but we do believe they'll be 2 years. But that's going to be one of the big questions coming out of this whole ordeal.
Okay, from 10 to 2, and we'll see what the implications are for the economy then. As you say, how close is the Treasury then, Bill, to running out of cash?
Well, that's been the latest red flag raised over these talks. Treasury's cash balance fell below $50 billion on Wednesday. It had been at $75 billion just the day before. And in comparison, it was at nearly $1 trillion a year ago. So it's come down significantly. There's major payments on Social Security that have to go out on June 2nd, right after that potential X date. So we're really, the Treasury is really kind of scraping the bottom of the barrel at this point to have the cash to keep government operations funded.
Okay, Bill Ferry's on the latest when it comes to the negotiations of the debt ceiling, of course, and just where the Treasury stands in terms of the cash in its coffers. Thank you. Let's bring in now Eleanor Taylor-Jollidan, co-head of Swiss and Global Equity at UBP. Eleanor, always a pleasure to speak to you. Let's start with the debt ceiling then. Do you take solace from what we've been hearing over in Washington in terms of the progress that's being made in these negotiations, or do you want to be focusing on hedging around potential additional volatility?
Without wishing to sound uninterested, I just yawn, actually. It's not the first time we've been here with these debt ceiling discussions. I find it, dare I say it, a little bit sort of politically irresponsible and irritating that we have to go through these fashionable, amusing, last-minute deals. But I don't find that they're very helpful either for the stability of the economy, the trust you can have in politicians, or the ability to plan for the future. And what always does seem to happen is that we find a last-minute decision is almost as if it's sort of being scripted for a television series. And I wish we could take things a little bit more seriously rather than having to go through this.
It sounds like then your assumption is it gets done, the deal gets done, and it sounds like you haven't made any significant changes in terms of positioning in the portfolio on the back of what you're seeing in DC. Is that the right line to take on this?
That's absolutely the right line. And I'd also point out that we do have relatively experienced people on both sides. And sometimes we point to experience being a negative in terms of sort of elderly statesmen, but sometimes it can be positive that people understand how to negotiate and how to push things through. Indeed, I'd agree with your previous interviewee that what matters is where the spending cuts or spending freezes will have to be effected. And if that puts back into question some of the opportunities to keep growth at a modest but nevertheless a growing level in the United States.
And Alan, look, we're going to bring the focus back to Europe and Switzerland, but staying on the US for now, the market's now pricing in 25 basis points additional hikes from the Fed coming through June, July. We don't exactly, of course, know when that's going to land. Is the pause narrative around the Fed crumbling? Do you align with that view? Does that seem reasonable, another 25 basis points?
I think they can do it, and I wouldn't see why they shouldn't do it. I was never a fan, we've talked often about this together, of the idea that we were going to go up on rates and then we were going to go down on rates for a long time. There's no reason why, with inflation where it is in the US, there isn't room for an extra rate hike. And then, yes, you can pause. Remember that they gave themselves space also to do another rate hike, if you like, by deciding that the SVB and banking difficulties that we saw in March was justification not to do the 50 basis points hike, which was expected, but only a 25 basis points hike. So why not go for another 25 basis hike now and then see how the summer goes? And indeed, if we look at data, it looks a little bit more positive, and the first quarter quarter earnings season was more positive than we necessarily expected. So I think there is room for it. Inflation has been a little bit more sticky globally as well. And so a little hike, why not? Just a signal that they're still there.
Okay, they could and they should with another 25 basis points. Eleanor, switching focus to Europe then, are markets underpricing recession risks in Europe?
I don't think so. I think that if we look at where we were standing at the beginning of 2023, there was a much more negative view on how 2023 was going to develop. And again, I come back to that earnings picture that we've had from the first quarter, and notably order entry in some areas, which has been a lot more positive than people would have necessarily expected. So I'm not someone who's really expecting either a recession in Europe and even perhaps not one in the US. I think the US is perhaps a little bit more fragile than Europe in terms of recessionary fears for a couple of quarters in 2023. But I think those areas could avoid that. Unfortunately, the downside to that argument is that we continue for longer with the type of low growth that we have been seeing over the last few years. We haven't got any economy booming at the moment or likely to develop very fast. We've got a difficult geopolitical situation around us. So I'm more of the lower for longer growth view rather than recession and then a boom out of a recession.
Okay, Eleanor Taylor-Jollison, thank you. You take, of course, on the central bank action out of the Fed and the prospects for slow growth for longer in Europe. We're going to get more calls, of course, from the co-head of Swiss and Global Equity at UBP just in the next couple of minutes. In the meantime, let's check in on a couple of individual corporate names to bring to your attention. UBS, we've done some reporting on this, great reporting from the Bloomberg team on the negotiations that continue between UBS and the Swiss government over that 9 billion Swiss franc backstop that was agreed as part of that takeover of Credit Suisse. It seems like it's going to be pushing the finalization of that takeover into June. They're also haggling over capital requirements, it seems, and liquidity rules. That is UBS and the Swiss government. Casino over in France plunging 9%. It was suspended the stock on Monday. A court has since ruled that they can start conciliatory procedures with some of their creditors. They're also looking to sell off some of their stores. The shares started retrading today, currently down 9%. Glencore gaining close to 3% on the back of the news and reporting that a part of its business, Viterra, which it has backed and continues to back, which is a grain trading business, is in talks for a potential deal with Bunge over in the US, which is the world's largest crusher of things like soybeans and canola. So Glencore gaining on the back of that news. Negotiations continue. A deal has not been finalized, but we are reporting that those conversations are at least ongoing. Now, we're going to go back to what is happening, of course, in the AI world. Chipmaker NVIDIA has been superpowered, of course, by artificial intelligence. How much boost has the wider market been getting, and is it sustainable? How do you invest around the enthusiasm of AI? That is coming up next. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Definitely are feeling a lot better than about 6 months ago. I recall probably talking about NVIDIA going up to $1 trillion company when it actually troughed at about 300 billion in October last year. But if we look at the fundamentals of the company, and our forecast remains still significantly ahead of the consensus. So we are definitely not selling, but at the moment it's already the largest position in the fund, and we cannot go more than 10% in the fund. So it's very close to that not line, but we think there's still further upside to go from here.
Okay, Blue Whale Capital CIO Stephen Newt speaking to Bloomberg's Danny Berger earlier on the surge of NVIDIA. That's his largest holding. He's been out front in terms of the prospects for NVIDIA, and it clearly has benefited on the rally that we've seen. Now, NVIDIA's forecast for surging revenue surprised even the most bullish analysts, of course, on Wall Street, pushing the chipmaker to the cusp of a $1 trillion market cap. AI-related stocks worldwide have also seen a jump in the wake of NVIDIA's bumper forecast. For more, let's bring in Bloomberg's Alex Webb. Alex, is this rally then overplayed?
I think there are two ways to look at this. There's NVIDIA itself, and then there's the kind of broader chip-making space. And what's pretty interesting, actually, when you think about NVIDIA itself, is that if you look at the price-to-earnings ratio, the forward price, the blended forward 12-month price-to-earnings ratio, it came down quite considerably yesterday, of course, because as analysts revised their estimates upwards. So it had been trading in the realms of 60 times its forward earnings. That's now come down to 49 times. If you look at this chart, you can just see that drop towards the end. It shows that actually, in a sense, the market's catching up with where the company certainly sees itself going. If you look at it in a two-year view as well, it gets down to the sort of 30 times multiple. That's actually closer, still at a premium to quite a lot of stocks, but closer to some of those other tech stocks that we're used to talking about. We look at the broader market, there is a lot of, excuse the pun, but investors spreading their chips at the moment. Partly because they don't quite know how to play this, it looks like. And there are a lot of substrate makers, machine tool makers, all stuff that goes into the chip industry. It is not clear that all of those players are going to be winners from the AI boom. We're kind of yet to see really how that plays out. The one big name we know, of course, is ASML.
Has Cathie Wood failed to understand how to play this? She hasn't benefited. ARK has not, the main fund at least, has not benefited from this incredible rally in NVIDIA, the recent rally at least.
Yeah, she seems to have been a little bit unfortunate with her timing on NVIDIA purchases because she got in a little bit late. I think she probably did benefit a bit from the NVIDIA rally, but then she got out before this massive one. In a sense, though, NVIDIA is a little bit of an outlier in terms of the sort of things she has invested in. She doesn't, on the whole, tend to invest in the real deep tech stuff. A lot of it is quite consumer-facing. It's the Teslas, it's the Roblox of the world. There's a stark difference from, you see investors such as William DeGale at Blue Box who really say we're going to invest in the underlying tech, the stuff that has a, long lifespan that is always going to be important. We're not actually keen to do the stuff that's super buzzy and voguish, which, buzzy and voguish is almost her USP, right? That's what she's trying to call. So perhaps it's not a surprise, but NVIDIA was always a little bit of an outlier.
Okay, Alex Webb, thank you very much indeed. On the latest when it comes to the AI-powered run-up with NVIDIA, of course, the beating heart of that rally, at least for now. Let's bring back in Eleanor Taylor-Jollison, co-head of Swiss and Global Equity at UBP. Eleanor, let's pick up on a point that Alex made, which is the challenge it seems that some investors are having in terms of riding this rally and picking the real material sustained winners. How are you thinking about aligning with the optimism around AI?
I think, first of all, it's not necessarily aligning with optimism on AI, but it's just seeing AI as part of the industrial makeup today and something which is going to help in a number of different sectors and areas, both in terms of the necessary suppliers for AI, but also the users and how that's going to enable them to be more efficient going forward without, and we haven't mentioned it yet this morning, mentioning some of the risks which are around AI. So we tend not to jump onto a bandwagon of a new technology, and we tend to be rather slow in saying the world is going to change dramatically and will never be the same again. And we tend to think rather more slowly about what is going to be needed in order to support AI, what are the risks in terms of regulation around AI, and who is already using AI, which perhaps we also forget, and has been using AI for a long time. So again, coming back to some industrial companies who have been doing a lot of machine learning, so perhaps not the snazzy stuff that we see at the moment in the press, but more the how do you get machines to be more efficient in a factory. And all of those will feed into our investment processes and our investment thinking.
Okay, some of the unglamorous, arguably, parts of the AI drive. Do you think, just broadly, the rally that we've seen this week, Ellen, do you think it's rational?
Short-term markets are rarely rational. Certainly, there were a lot of question marks, I think, around NVIDIA going into these results. It wasn't looking particularly cheap on the expectations for the stock going into the results, and that certainly does. There was a relief rally which happened, and we are at a time where we know that the semiconductor cycle is perhaps reaching that lowest point from which it can recover, and that the news that came out with NVIDIA yesterday certainly was very supportive then to stocks which are linked to the semiconductor cycle, saying, look, AI is actually going to be a strong demand and is going to replace some of the perhaps weaker areas of the semiconductor market that we've seen in recent times, or some of the more concerning areas. And that certainly gave a rally to some of the stocks which perhaps had more question marks over them prior to NVIDIA's results.
And Eleanor, just briefly, more broadly on the tech space, the Nasdaq up 30% year to date. Is tech a haven, given all the challenges that we face around the debt ceiling, around higher hikes, rate hikes, the stickiness of inflation? Does tech have further to run?
I come back to what I said last time I was on Bloomberg, which is I think tech is a very, very large and very diverse sector today. And we've got to be quite careful when we say tech is a haven. So even beyond saying what is hardware, what is software, and actually then think within the AI complex, what does AI mean for software producers? Does that change the outlook for them? Then look at some of the media parts of the tech space. There again, perhaps there are more questions, more fears perhaps around AI than for other sectors. So it's again, I would argue, much more important to choose your stocks carefully, to look for what has got a new boost perhaps from AI in terms of their ability to create value, and to choose those names rather than just ticking a box and saying, oh, it's the AI thematic, therefore it's going to work, because you may find yourself out in the cold if you do that.
Okay, the message seems to be do your homework and maybe look at some of the industrial opportunities around AI, some of the less glamorous parts of this space. Eleanor Taylor-Jollison, thank you so much for joining us this Friday, co-head of Swiss and Global Equity at UBP. Coming up later this hour, economists expect China's central bank to cut the reserve requirement ratio for major banks earlier than expected. That's as the economic recovery loses steam. We get more on that. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Welcome back to the Open. We are 25 minutes into the European trading day. You're actually seeing gains across European equities of 0.4%. You're flat in terms of the US futures. The key sector leading this rally here in Europe is basic resources, getting 2.6%. Let's get the Bloomberg Business Flash now with Alex Morgan. Alex.
Good morning, Tom. Alibaba says it plans to hire 15,000 people this year, pushing back on reports the firm is laying off staff. The Chinese e-commerce giant described reports of layoffs as rumours, and said employee departures are part of the normal flow of the business. Bloomberg has learned that the TSMC is in talks to receive German government subsidies for up to 50% of the cost of a new factory. Our sources say the negotiations involve a plant in Dresden to be built at an estimated cost of close to $11 billion. Well, the top end of the subsidies being discussed are similar to what Japan has offered TSMC. And Cathie Wood's flagship ETF closed out its Nvidia stake in January, missing out on the stock's recent powerful rally. The chip maker, the world's most valuable, has added more than $500 billion in market cap since Wood dumped the shares. Wood holds Nvidia across several of her smaller funds, but investors in the flagship ARK Innovation ETF have missed out on Nvidia's blistering rally. That is global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg, Tom.
Alex Morgan here in London. Thank you. Let's check in on some of the stocks on the move at the Open. The fashion retailer based here in London, ASOS, gaining on the back of news that it is indeed doing a capital raise, giving some clarity, according to analysts, around the prospects on visibility around liquidity, at least for that business. That is according to Citi analysts, a bit of an upside there for ASOS. Rio Tinto being upgraded by Morgan Stanley, rallying 3.6%. Morgan Stanley pointing to its copper holdings being underappreciated. And Glencore gaining 2.8% on news that its grain trading business, Viterra, is in talks, potentially to merge with Bunge. Plenty more coming up. This is Bloomberg.
half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day. Here are your top stories. Negotiators inch closer to a deal on raising the US debt ceiling, said to include capping federal spending for 2 years. Cathie Wood's flagship ARK fund dumped NVIDIA stock right before the chipmaker's blistering $560 billion rally. Plus, tech stocks propel Asia markets higher, even as US futures stall before key US inflation data today. 2-year Treasury yields snap 10 days of gains. Okay, we'll check on in these markets then as we weigh up, of course, the expectations that maybe the inflation print, PCE, out of the US later today is going to inform the views around the Fed as markets price in 25 basis points. That is now fully priced in by these markets between June and July. It either comes through June or July. So the pause narrative is starting to crumble in terms of the Fed. And of course, you had those job claims being revised lower, just underscoring once again the strength still of that US labour market. Here in Europe, the equity market's posting gains of 0.4%, picking up the baton then from a positive session over in Asia. And of course, that blistering AI-powered NASDAQ rally of around 2.5% yesterday. The DAX gaining 22 points, even as Bloomberg is reporting on the travails and the struggles of the German economy. That is a story worth looking at on your Bloomberg terminal. The FTSE 100 gaining 32 points, up 0.4%. Some slightly stronger retail numbers coming through, but it's really basic resources. It's copper, it's iron ore that is driving the FTSE 100 higher this morning. Talking of those sectors, let's see how the breakdown is shaping up 31 minutes into your trading session this Friday then. I talked about the upside that we're seeing in terms of pricing for copper and iron ore. Broadly for the week, though, those commodities have been under pressure. The other story coming through for the FTSE 100 is the Morgan Stanley upgrade for Rio Tinto, saying that its copper holdings are underappreciated by these markets. Basic resources then as a sector gaining, leading the charge up 2.8%. Technology, despite the yields run up that we've seen, of course, and a reminder that on the 2-year US yield, in 30 days, yields are up 80 basis points. Technology, nonetheless, is gaining 0.9%, linking to that AI enthusiasm. Bottom of the list, you've got real estate and telecoms down 0.2%. Let's get to the banking space then and details around Credit Suisse. A unit there has been ordered by a Singapore court to compensate a billionaire for what may well be hundreds of millions of dollars. The bank says the judgment is, quote, wrong, and it will appeal. Let's get the stories then and the detail from our senior reporter for global equity markets, JP Barnett. JP, what does the case mean then for Credit Suisse going forward?
Yeah, that's the question. I mean, the case is hanging on Credit Suisse now for quite a while, and I would say it's like amid the core package, so to speak, that led to the downfall of Credit Suisse, because it speaks to the lack of control and the lack of risk management that Credit Suisse had before it was taken over by UBS. So a billionaire suing Credit Suisse for defraudment of one of Credit Suisse employees, a rogue banker. And Credit Suisse, of course, is arguing that it did everything it could and that there is no 100% safeguard for fraud. But still, I mean, we know that Credit Suisse had a lack of risk management and preventing mishaps in their business overall. And so this ruling might not be so much about the money, though it's of course damaging for the bank. It's more about the reputation going forward. And it's going to be interesting how UBS is going to spin this. Of course, they're going to blame this on the legacy Credit Suisse management, but overall, it's not boding well for the reputation of the bank going forward.
Yeah, not good news for Credit Suisse, obviously, not good news for its new owner, UBS. Talking of which, it kind of underscores the whole UBS point around needing that backstop from the Swiss government. And we know that negotiations there are at a pretty tortured phase. What are the details? What do we know about any kind of resolution and when they get this deal finally across the line?
Well, I would say it's not too surprising because the Swiss government got a lot of heat for, again, spending billions in taxpayer money for rescuing a bank. So now it was kind of clear that there will be hiccups in the negotiations, like how the 9 billion can be used, what the details will be, when and where and what. And of course, UBS will try to get the most out of it and be able to put as much money into this basket as they can. On the other hand, you have the Swiss government who will be very keen to maybe at the end of the line say like, oh, look, we didn't even need the full 9 billion to make this all happen. So I would guess that we see a little bit more of back and forth there before we get a final close of the deal. Of course, that's not great for the stock because stocks, I mean, we never like uncertainty in the stock market, and everybody's hoping that this merger is going rather fast, even though it's complicated. And if there are like too many hiccups here and this is going too long and it's being prolonged too long, then I guess investors will get a little bit nervous.
Yeah, indeed. A bit more haggling to be expected then in that negotiation. UBS, that stock currently down 0.9%. Bloomberg's JP Barner, thank you very much indeed for the latest. Now, let's get the Bloomberg First Word News with Alex Morgan. Alex.
Tom, good morning. Turkey's central bank has kept its benchmark rate on hold at 8.5% for a third month in a bid to stabilise the lira. That policy decision comes ahead of the election runoff on Sunday. President Erdogan looking to extend his two-decade rule after leading the first round of voting, but failing to take that 50% earlier this month. Siemens Energy says it's experiencing a surge in demand for green transition technologies as government around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, the CFO, Maria Ferraro, says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
And the Bank of Japan's governor, Kazuo Ueda, says the BOJ's balance sheet isn't necessarily in a normal state, given the bank's large holdings in government bonds and ETFs. Ueda has also played down the importance of wages or any single economic data set as a trigger for change. This suggests his desire to hold on to policy flexibility, leaving speculators guessing about the timing of a policy shift.
On how wages might lead to policy change, we aren't targeting wage growth itself. If we have sustainable and stable inflation of 2%, it's natural that wages should also rise. The key point for our policy decision is whether inflation will rise in a stable and sustainable manner at 2%.
Well, that is global news on your Friday morning, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Tom.
Alex, thank you. Now, Nobel Prize-winning economist Paul Krugman played down concerns about the US government's burgeoning debts ahead of potential default next week. He told Bloomberg's David Weston that current US economic policies risk undermining the country's future prosperity.
The thing that concerns me most, I mean, partly we're just talking about the functioning of the government, right? We're talking about being able to get some money on the line. With the Social Security administrative costs, the IRS. It's not just that we're giving the IRS resources now that will help it crack down on tax evaders, and that's one of the things Republicans want to cut. The other thing is, if you have a question or a problem with your taxes, it's gotten suddenly a lot easier to get hold of somebody at the IRS, which was, still is to some extent, in desperate straits. But what really bothers me, where we are right now, is that the programs that apparently are sacrosanct are programs for the elderly. Medicare, Social Security are off the table. They're being protected. And a lot of the stuff that's discretionary is really things like programs that support children, that support education, that support nutrition for the young, which is the future. So what's happening right now is that in the effort to hold down headline spending right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
So that is a terribly important and very unpopular point, going back to the politics for a moment here, and that is when you say, let's cut things for the elderly. That's not very popular. I'm elderly at this point. But at the same time, we're not really investing in future growth, as I understand it, by paying more, for example, on Social Security, whereas investing in education or children or infrastructure could increase the future growth. To what extent do we need to be concerned about growing ourselves out of whatever debt issues we have?
Well, to a large extent, that's going to happen anyway. I mean, when I say you need to adjust for inflation, you really also need to ask about growth. And, the example I always like to use is, how did we pay off the debt from World War II? And the answer is we didn't. We had slightly higher debt when John F. Kennedy took office than we did on, when we declared victory over Japan. But the debt had dwindled. It was less than half the share of GDP that it had been at the end of World War II, because we had a growing economy and a little bit of inflation over that period. And that's largely, we're still in a world where we really are already set to, if not exactly grow out of our debt, at least not have it grow very much, uncontrollably, unless we do, some really even more irresponsible things than we do now.
Okay, Nobel Prize winning economist Paul Krugman there, speaking to the anchor of Bloomberg Wall Street, David Weston. Now, Germany, Europe's economic engine, of course, is at risk of a slow economic decline. That is the subject of today's Big Take. We're going to discuss that next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupied areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Welcome back to the Open. We are currently 43 minutes into your European trading day. Happy Friday. You're seeing gains slightly to pairing across European equities. Gains of about 0.1%. Futures turning lower in the US after that red-hot NASDAQ rally that we saw yesterday. Gains of 2.5% yesterday on the NASDAQ. Currently, the NASDAQ futures pointing to losses of 0.2%. The S&P E-minis down by 0.2 as well. Let's get back to what's happening here in Europe then. Europe's economic engine is having its resilience tested and is at risk of a long, slow decline, with consequences, of course, for the whole of the EU. Germany is the subject of today's Big Take. Joining us with the details is Bloomberg's Oliver Crook in Frankfurt. Ollie, we had the recession then, of course, in Germany. Had that confirmed earlier this week. But longer term, there's a list of issues threatening this economy.
And really at the top of that list of issues for everybody is the energy crisis. And really, if you think about the kind of recession, which is what, minus 0.8% over 2 quarters, with what was really considered an existential threat to the economy and industry, maybe you got away sort of okay. But longer term, this is a very industrialized economy. It requires a lot of energy. There is not a solution to how to replace that Russian gas. The renewables are not sort of forthcoming. It's not exactly a sun-drenched nation, contrary to what we see today. So you have to think about where is this energy going to come from in the future, and then that only sort of begins to scratch the surface. You have questions on the labor market. You have more than 300,000 people becoming of retirement age this year, more than are becoming adults. So you have that, particularly for skilled labor when you want to attract semiconductors and other kind of more complex, future industries. You have EVs, the sort of the elephant in the room. This is the biggest industry in Germany. It employs more than 800,000 people, all said and done. The transition to the EVs, Germany is sort of lagging on this. Plus, it requires fewer parts for these cars. So you have all of this combination looking forward down the line. I spoke to Otmar Issing, one of the first chief economists of the ECB, one of the people who has studied the German economy sort of in greatest depth and over a greatest period of time, and really who I was struck by how pessimistic he was about the prospects going forward.
Okay, the pessimism is real, the pessimism is there, the challenges are there. What are the fixes then, Ollie, that are being identified?
So you have to imagine part of the solution will have to be a political one. That is sort of complicated now when you have the three-way coalition not acting very sort of cohesive, because you really need a plan that goes over an extended period of time and that is sustained. So you have to work that out. And also you have to match these huge programs out of China, out of the United States, the Inflation Reduction Act. What can Europe do to kind of catch up on these things? And also maybe some of the low-hanging fruit, dealing with some of the bureaucracy, attracting more investment. And if you're able to do that, Germany really has a huge amount of innovation. It has these huge companies like the auto sector, where even if they're playing catch up, they're dumping literally hundreds of billions of dollars into trying to get there. You have the Mittelstand, where you have more than 1,000 companies that are the best in the world at very sort of precise things, whether it's sort of bending tubes, retractable dog leashes, or even building tunnels underground. The biggest company that does that is a small German company. Glass perfume bottles, all these sorts of things. But really the problem is, I think, that things feel sort of okay at the moment. So if necessity is the mother of invention, perhaps necessity is not as evident as it needs to be. When we had the energy crisis, they got these, the LNG terminals in very quickly. But I think that with these slow burning issues, if you don't feel the necessity, will you be able to coalesce all of your efforts to try to deal with these problems?
Okay, yeah, maybe the argument for a bit of shock treatment for the German economy. They certainly, as you say, saw that around gas. The dog leashes, I was unaware that Germany led on retractable dog leashes. There's the headline for the day. Ollie Crook, thank you very much. News you can use, always, from Oliver Crook in Frankfurt. You can't talk about the German economy, of course, without talking about the Chinese economy. So we're going to switch there now. A Bloomberg survey of economists reveals that the country's central bank will likely cut the reserve requirement ratio for major banks earlier than expected. This, of course, as the economic recovery appears to be losing steam. Let's bring in Bloomberg's managing editor for Greater China, John Liu. John, why then is the PBOC likely to make these moves earlier than initially expected? How much of this is down to the softer than expected economic data?
I mean, it's almost entirely down to the softer than expected economic data. When China removed all the limits associated with COVID-0 at the end of last year, the expectation widespread was that the economy was going to come back roaring. People were going to get out of quarantine and go out and spend. Factories are going to start churning out product again. And to some extent, that has happened. There has been growth in the first quarter, in the first 4 months of this year. But the data that we got in April showed it was not as good as people had hoped. Be it retail sales, be it investment, be it factory output. It's all trailing where economists had thought China would be by this point. And so on top of that, we have youth unemployment at a record high. 1 in 5 people between the ages of 24 and 16 cannot find a job here. That's putting a lot of pressure on policymakers to act. And what we've seen now is economists betting more than ever that the central bank's hand will be forced, like it or not, to take some action to revive that recovery.
Okay, John Liu, excellent. Really appreciate you staying up for us. John Liu in Beijing on the prospects of potentially another RRR, or at least an earlier RRR coming through from Chinese policymakers as they try and address the slowdown, or at least the less than aggressive pickup we've seen in terms of the growth trajectory for that economy. Thank you. Now, Turkey is heading back to the polls this weekend for the second round of the presidential election. We're going to get you a preview next. That vote this weekend. Stay with us. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Season is here.
Earnings season is in full swing.
UK consumer is still strong.
Bloomberg breaks the numbers first.
UniCredit smashing the earnings.
Underlying sales up by 10.5%.
Volkswagen, BMW.
Deutsche is on fire.
With exclusive expert analysis.
The first quarter was very challenging.
Do you worry about the supply chain?
I'm really pleased with the quarter's results.
What's your timeline for this actually being able to reach market?
Our business remains very resilient.
The overall performance has been stellar.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
It is Friday. Welcome back to the Open. 52 minutes into your European trading day. Some of the earlier gains being paired across the European benchmark, now up just 0.2%, and the futures are lower in the US. S&P E-mini is down 0.2%. The sector that is leading in the session so far in Europe is basic resources, with iron ore pricing up around 4% in the session, and as a sector, basic resources up 2.3%. Now, a further line on Credit Suisse and UBS, and there's been a number of lines that come through just in the last 12 hours or so, and this is a Bloomberg scoop. It's a redhead across the terminal. UBS and Credit Suisse are set to offer incentives for their wealth bankers over in Asia. They're going to be giving them a cut, basically, of the new money that they bring in About 15 basis points in terms of commission, so actually more generous in some cases than their actual bonuses. So this is just a reminder of the importance of Asia as a wealth driver for the wealth management part of those businesses, and steps there being taken by UBS and Credit Suisse to award and incentivize the bankers in that part of the world. We'll bring you more on that as and when we get it, and that is a scoop from Bloomberg. Now, to Turkey and the politics of that country. Turkey's central bank, before we get to the politics, the central banking picture, has extended its interest rate pause for a third month as it tries to keep the lira stable. It's again been under pressure, of course. The policy decision comes just ahead of that country's presidential runoff this weekend. Bloomberg Daybreak Middle East anchor Yusuf Gamaluddin joins us now. Yusuf, why then is this important?
So, Tom, the repo rate gets held at 8.5%, and it's important to understand that as a central bank, they don't want to be seen as taking sides as we count down to the Sunday runoff. The bigger question, arguably, is what happens post-Sunday. You've got a backdrop where in the first round, the incumbent Recep Tayyip Erdogan won 49.5% of the vote. His most credible threat was Kemal Kılıçdaroğlu. He came in second, and then Sinan Oğan, he basically came in third, but he's not going to take part in the Sunday vote, and he has thrown his weight behind Recep Tayyip Erdogan, which of course bolsters the opportunity set for the president at the moment. The inflation story is front and center at 44%, and Erdogan reiterated his view that what he's been doing in terms of low rates would continue after the election. For mainstream economists, what he's been doing, even though he's made quite a name for himself on that strategy, it is not sustainable. You cannot lower rates when inflation is high, and that means Turkish assets broadly are going to be at risk of a further sell-off, especially with the local currency already hovering at a record low.
What about reserves? Can they dip into those reserves to kind of support the lira? To what extent is that going to pose a challenge for whoever wins this presidential race?
Well, I think you hit the nail on the head. It's a bit tricky because their net international reserves have turned negative for the first time since 2002, so in 21 years. And if you thought that it's not possible that they can go negative, well, Turkey clearly shows that it can. And it also tells a story of a struggle for foreign currency as the country continues to regularly intervene in the foreign exchange markets to try and stabilize the Turkish lira. Liquidity has been low. It's not the best representation in the last few weeks about where investor sentiment is. I would look to the credit default swaps. I would look to the country's bonds. And I would also look to what is going on with stocks, because at the end of the day, at the beginning of the year, this was an inflation hedge for a lot of local Turkish investors. That's no longer the case. Year to date, we're down about 18%. And so with a continuation potentially of some of the controversial policies, there's a lot of angst, uncertainty as we count down to Sunday, Tom.
Okay, Bloomberg's Yusuf Gamaluddin on that preview, of course, on the challenges for whoever wins that election in Turkey. Quickly checking your markets. Equities now up 0.3% here in Europe. Futures pointing lower by 0.2 in the US. Yields coming in by 4 basis points at the front end. And the dollar, the Bloomberg Dollar Index, is now down 0.2%. So a bit of a reversal of some of the asset moves that we've seen this week. That is it for the European market open. Surveillance is next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded,
and then the personality behind it. The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Taking shape, debt talks in D.C. inch towards an agreement, which is said to include lifting the cap for 2 years. Missed the boat. Cathie Wood's flagship ARK fund dumped NVIDIA stock right before the chipmaker's blistering $560 billion rally. Plus, tech stocks propel Europe and Asia markets higher, even as U.S. futures stall before key U.S. inflation data. 2-year Treasury yield snapped 10 days of gains. Well, fitting that it's Friday and we're getting a pause, a breath, a consolidation of some of the major trends we've seen this week. We are looking at some gains on European indexes. If you look at where this is coming from, it's from a lot of places that had been beaten up over the week, so a little bit of nibbling around the edges there. NASDAQ futures, those come in. Of course, it was such a strong rally yesterday, all off the back of NVIDIA. NASDAQ itself rallying about 2.5% yesterday. NVIDIA adding $180 billion worth of market value. Really one of the top biggest movers in history. Apple and Amazon, I think, each had a day that was better in terms of adding market cap, but it is still up there. 2-year yields, again, these come in. It had been a day of selling off bonds yesterday, the front end getting clobbered. We had some jobless figures that showed that this is still a hot market. There was a lot of revisions to past data too, which suggested the trend actually isn't as improving as we thought it was. Finally, euro dollar, again, this is a bit of a change. The dollar, it had been strengthening to a point where we saw the yen hit 140 per dollar. But again, that's coming in a bit this morning. Now, looking at the overall Europe, Matt, again, I mentioned that for Europe, it's a lot of reversals of some trends. The CAC 40, for example, that's basically unchanged this morning. It has fallen about 3.5% this week, so we're taking a pause there. A lot of metal and mining companies doing well. Commodities having a pretty strong day, again, after a week. So we're looking at FTSE 100, that's doing better. Of course, a lot of those companies living in that index. All right, let's talk about the debt ceiling, because it's really been our top story all week. White House and Republican Party negotiators are said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. Meanwhile, the amount of money the government has to pay its bills tumbled to the lowest since 2021. For more, let's bring in Bloomberg's Jill Desis. Jill, how close are we to getting a deal at this point? Are we any closer than we were 24 hours ago?
Well, Danny, it actually does seem like maybe we're moving a little bit closer. So what we've heard is that, as you mentioned, this plan seems to be in the works. Potentially, we've got an agreement to cap federal spending for 2 years. Of course, this is a far cry from what Republicans originally wanted, which was a 10-year spending cap. We've heard that the amount under the cap has not yet been finalized. There's some discussion about maybe allowing defense spending to increase next year. Maybe there's some conversations happening about upgrading the electric grid for renewable purposes. Maybe there's some speeding up some pipeline permits, which is something that Republicans would want. There's still a lot that needs to kind of be hashed out here. But ultimately, what this means is that there could be something that the White House negotiators and then these Republican negotiators put together by Friday in the U.S., so today. And then because there's an extended holiday weekend for Memorial Day, ultimately what that means is that there could be something that's presented to Congress to vote on by Tuesday. So we're really running up pretty hard against that deadline there, that X-Day deadline of June 1st. But ultimately, yes, it does seem like maybe something could go forward.
So if we were to get something like spending caps, what would the implication of that be on the broader U.S. economy?
Well, I think what we need to do is we need to see the devil's in the details, right? So we need to see exactly how all of this progresses with what those spending caps look like. Is that going to be finalized? Is that something that Congress is going to, be voting on? What economists have said in the past is that spending caps have the potential to tip the economy into recession, or I guess at this point, if the economy is already in recession, deepen issues there. I do think it has some implications for the Federal Reserve's interest rate hike cycle, but we'll have to see what those details look like once we get those a little bit, hopefully later Friday or, potentially into next week. So I think still a lot more to come as we get more details, but it does seem like today at least is more optimism, or at least more signaling that we're moving closer to something that we've had really all week.
Yeah, and of course we had that warning from Moody's that there's that June 15th interest rate payment. If they don't get there, that might be the source of a downgrade. Jill, thank you so much for your coverage. That's Bloomberg's Jill Desis. Now, short-dated Treasury yields surged yesterday. I mentioned this after U.S. jobless claims came in lower than expected. GDP at the same time was revised higher. But the 10-day rally in the two-year yield has been taking a bit of a breather this morning. But that is off the back of the longest streak of advances in 5 years. Traders are now pricing in a greater chance of further interest rate hikes by the Fed. Let's speak about this to Frederic Carrier, Head of Investment Strategy at RBC Wealth Management. Frederic, so we're taking a pause today, but the trend is in for the week. Higher two-year yields, a flatter curve. Do you want to follow that, or do you want to fight against the trend?
Look, we don't think that the best investment opportunities are in the US at the moment. We think that US rates are fairly valued. We think that US equities are priced for perfection, for avoiding a recession, inflation coming down. For us, there are better opportunities in the UK markets, particularly with respect to fixed income. We think that the market is much too aggressive in terms of its expectations of UK interest rates. We don't see the Bank of England being able to move as far as the Fed in terms of interest rates because of a much more powerful monetary policy transmission mechanism in this country than in the US. So from a fundamental point of view, we think that UK rates are interesting. And of course, they've been very, very oversold. So this is where we would seek opportunities.
Oversold, especially in the past 2 days, if you're talking about the movement. We are 6 basis points, somewhere around there, from that top we saw after the Liz Truss mini budget. And Frederic, you talk about this idea of the transmission mechanism, of the transmission of tighter policy to people in the UK. Why then haven't we seen inflation come in? Why are we still looking at persistent prices in this country?
There's always a lag between the tightening of monetary policy and what we are experiencing on land. So we would expect this to start showing up later in the year, for inflation to start falling more visibly later in the year. However, yes, it does take time. There is a lag.
How do we actually judge that? Because it's not like the rate hikes are new. It's been happening, and it's been happening quickly. How do you actually assess? Because we hear it all the time, long and variable lags. But what does that actually mean? What are we waiting for? What needs to happen to see some of the effects of tightening policy show up?
So we probably need to see some mortgage renewals taking place, and there's a very high percentage of mortgages which will be renewed later in the year that will put further pressure on household budgets. But remember, what has driven inflation has been energy prices. Monetary policy can't do very much on that. And now it's really food prices. Again, monetary policy is quite powerless. So what the Bank of England is trying to do is try to ensure that inflation expectations are not anchored at too high a level and try to impact wage gains, trying to ensure that they are not running too far ahead of inflation. And of course, at the moment, wage gains are quite strong. It's wage gains, it's corporate pricing power, which are really ensuring that inflation is remaining at much too high levels.
So if you think UK gilts, if they're attractive right now, where on this curve are you buying?
So given that we think we are probably closer to the end of the tightening cycle, we prefer the long end towards rather than the shorter end.
Okay, Frédéric, really great to have you on this morning. We appreciate your time. Frédéric Carrier, the head of investment strategy at RBC Wealth Management. Coming up on the program, missing the boat. Cathie Wood's ARK dumps NVIDIA stock before a $560 billion surge. We're going to discuss that and more on the AI boom next. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
Definitely are feeling a lot better than about 6 months ago. I recall probably talking about NVIDIA going up to $1 trillion company when it actually troughed at about $300 billion in October last year. But if we look at the fundamentals of the company and our forecast remains still significantly ahead of the consensus. So we are definitely not selling, but at the moment it's already the largest position in the fund and we cannot go more than 10% in the fund. So it's very close to that line, but we think there's still further upside to go from here.
Blue Whale Capital CIO Stephen Yu speaking to me earlier on the surge of NVIDIA, his fund's largest holding. But a rising tide doesn't lift all boats. ARK Of course, Cathie Wood's flagship exchange-traded fund closed out its NVIDIA stake in early January, right before the AI frenzy that sent the stock and its big tech peers on a tear. Now, in February, when NVIDIA traded at $234 a share, roughly 50 times forward earnings, Wood said that the valuation was, quote, very high. Now, she still does have a stake, it's a small one, in the chip maker through 4 smaller funds. For more, let's get to Bloomberg's Alex Webb. So, okay, she does still have some of this, but she seems to have largely missed out on the rally so far year to date for NVIDIA. Why would her approach be different in that she would ditch it right before we saw this big upswell?
Yeah, it was interesting because, like, actually NVIDIA sort of looks like a bit of an outlier in terms of the companies that she tends to invest in. It is, you know, fundamentally deep tech. She doesn't have many of those. A lot of the things that she does are kind of more consumer-facing. There are, of course, some things in genomics and biotech where she has some investments, which isn't obviously consumer-facing, but they often kind of make products. NVIDIA is really in the component space, and perhaps it was almost a surprise she had it, given the nature of other investments, which are like Tesla, Roblox, things like that. So I don't think she missed it completely. She, as you say, I think she has about $150 million stake in NVIDIA as things stand, and she rode a little bit of the prior wave, but she has, it seems, missed out on the massive money.
Well, if you want to buy based on valuations, Alex, we've been talking about this, and I find this really fascinating because you could say, okay, look at this huge rally, but I know you've got a deeper dive into just some of the ratios here. I mean, valuations have come down.
So in a sense, NVIDIA's become cheaper,
yeah.
Right? It was actually trading at around 60 times its forward earnings prior to this announcement. As it increased its forecast, what we've seen then is analysts also increase their estimates. Consensus has therefore gone higher, which means the price to earnings ratio, and you can see it in this chart right at the very end there, falling off a cliff, that is the drop in the PE ratio. So it has come down to that 50 times forward earnings, 49 times I think it is, which of course a few months ago Cathie Wood was saying looks expensive. But if you look on a slightly longer time frame, 2 years, 3 years, it comes down to below 40, and that isn't actually massively out of kilter with other parts of the S&P 500. So look, I'm not a stock picker. It doesn't look, though, as crazy as at a first glance might have you believe.
I think you're literally prevented from being a stock picker by being a Bloomberg News employee, so I hope you're not, Alex. Look, that chart also says to me just this big readjustment in forecasts and forecasted earnings is that a lot of people were just caught off guard by how strong their earnings were. Why, though? Why was this such a shocker? I mean, a good shocker, but such a shocker coming from NVIDIA?
Well, people didn't quite know how real this thing was, right? We've had lots of false dawns in technology over the past however many years. You know, Web3 was supposed to be a huge thing. It's sort of fizzled, and we haven't, I'm not going to say it's died, but we aren't really seeing much meat on the bones yet. AI looks like a real technology, and crucially, look at the people who are driving it. It's Google, it's Microsoft. These are companies who are selling it essentially as a cloud product. If it's going to be a cloud product, they need to have the infrastructure to support it. That's why they're turning to NVIDIA. I think there was also some questions about whether there was enough capacity out there. It is very clear now that there is, right? There is the capacity to make these chips, largely because a lot of the new investment in semiconductor capacity is at that bleeding edge, you know, sub sort of 7 nanometer. That is the stuff that is feeding this rally from NVIDIA.
Yeah, and it was those supply chain pains, which I guess have kind of, you know, eased off as well. A story from COVID really through the past couple of years. Alex, thank you so much for joining. That's Bloomberg's Alex Webb there on NVIDIA. Now, coming up, Turkey heads back to the polls this weekend as the president faces his first ever runoff election. We're going to have more on what's at stake next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your first word news. With that is Alex Morgan. Alex.
Danny, good morning. Bloomberg has learned that UBS and the Swiss government haven't agreed the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources tell us the deal's completion could be pushed back to June instead of late May. Well, UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. The Bank of Japan's Governor Kazuo Ueda says the BOJ's balance sheet isn't necessarily in a normal state, given the bank's large holdings of government bonds and ETFs. Ueda has also played down the importance of wages or any single economic data set as a trigger for change. This suggests his desire to hold on to policy flexibility, leaving speculators guessing about the timing of a policy shift.
On how wages might lead to policy change, we aren't targeting wage growth itself. If we have sustainable and stable inflation of 2%, it's natural that wages should also rise. The key point for our policy decision is whether inflation will rise in a stable and sustainable manner at 2%.
Going green, Siemens Energy says it's experiencing a surge in demand for green transition technologies as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, the CFO, Maria Ferraro, says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Well, that is global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you very much. Now let's talk about Turkey, and its central bank has extended its interest rate pause for a third month as it tries to keep the lira stable. The policy decision comes just ahead of the country's presidential runoff this weekend. Bloomberg Daybreak Middle East anchor Yusuf Gamal-Eldin joins us now on this. So Yusuf, this interest rate decision, why is it so important heading in to the election?
Well, Danny, I mean, you already laid the groundwork there, but it's all about a repo rate that stays at 8.5%. No change as we count down to the runoff for the presidency on Sunday. The reality is that you've got inflation at 44%, and the central bank's already been intervening in the Turkish lira trade to try and offset some of the weakness. They did not want to be seen taking sides. And the bigger question is, who's going to come out on top on Sunday? Remember round one, the incumbent President Recep Tayyip Erdogan, he got 49.5% of the vote. Kemal Kılıçdaroğlu, his most credible threat, came in second. And Sinan Ogan, who was the third contender, he is now backing the incumbent Recep Tayyip Erdogan. As much as the president has made a name for himself with unorthodox monetary policies, the vast names that we've spoken to in the run-up to round one and a little bit after as well in the last few days suggest that they're not sustainable, these low policies. You cannot keep interest rates low at a time of high inflation, Danny.
At the same time, Yusuf, Turkey's net reserves have fallen below zero. What's at stake there?
Well, I mean, look, I've not encountered a negative net international reserves position before in any of our coverage, and we had to go back 21 years to see precedent in Turkey. And you reach a net international reserves position when you're struggling to attract foreign currency. In this particular case, it is when you've got reserves that are lower than your liabilities. At the same time, the local currency is not the best indicator of investor sentiment. If you're looking to see how investors are positioning, you look at the credit default swaps, you look at bonds in Turkey, and you look at the stock market, which was, for local investors, an important hedge for the high inflation rates. That's no longer the case. Stock on an index level have come down, so we're lower by about 18.5%. It gives you a sense of the kind of stakes that are at play. As we count down to Sunday and probably going into very early Monday, we should have a clear picture about whether President Recep Tayyip Erdogan is going to get another term or Kemal Kılıçdaroğlu is going to take over.
Okay. Yusuf, thank you very much for that. Looking forward to your coverage of the runoff. That's Bloomberg's Yusuf Kamal Al-Din. Now, today has been a lot of pulling back from some of this week's trends. We are looking at UK two-year gilt yields that have come in a bit, but look at this one-year chart. So if you see that spike up in September, that was the mini budget from Liz Truss when we saw pensions having to unwind due to margin calls and the BOE needing to step in. Today, we are alarmingly close to that level. It's a run-up over the past 2 days. Again, it's coming in today, but a run-up of more than 30 basis points, which got us there. I was talking to Athea Spinoza of Saxo Bank earlier, who said she is worried. There's less stress in the system. We're more prepared for it this time, but that doesn't mean we're in the all clear. The BOE might need to act more aggressively. Coming up, we're going to talk about the debt limit negotiations in Washington. This is Bloomberg.
Say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. There's certainly been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Taking shape, debt talks in D.C. inch towards an agreement, which is said to include lifting the cap for 2 years. Missed the boat. Cathie Wood's flagship ARK fund dumped NVIDIA stock right before the chipmaker's blistering $560 billion rally. Plus, tech stocks push European and Asia markets higher, even as U.S. futures stall before key U.S. inflation data today. 2-year Treasury yields snap 10 days of gains. Good morning. Happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the amount of money the U.S. government has to pay its bills has fallen to the lowest level since 2021. With less than $50 billion remaining, the Treasury could run out of funds as early as next month if a deal isn't agreed to raise the debt limit before then. Let's get more on this with Bloomberg Markets reporter Justina Lee. Less than $50 billion. What does that say about when we might run out of money at this point?
I know. Treasury Secretary Janet Yellen keeps saying, the deadline is the start of June. There's still a bit of debate about that. But what's interesting is that a lot of sell-side strategists have kind of moved forward their prediction of this X-date to kind of align with the administration's prediction, so around, the start of June. Even though there are some people that still think that maybe the U.S. government will have some leeway through summer, but there's definitely a sense that anxiety is rising.
It's kind of hard to figure out how the market is taking this because you have to also deal with the Fed, you have to deal with NVIDIA. Where are you looking at to try to get a sense of how the market's handling all this?
I think the most obvious sign is what's happening with the Treasury bill curve, where you very obviously have this spike in the yield premium around the date of, the X-date, which is around June 1st. And what we're seeing here is that yield kind of popped above 7%, but it's receded a little bit in the last few days with some optimism over an agreement. And I think another place where that's very obvious is the credit default swap market, where the U.S. is now demanding a premium that's actually even higher than a lot of EM countries. But I think you're right. Apart from that, stock market seems, pretty sanguine overall. The Treasury market, obviously, there's also the Fed factor coming in. And so I think in the stock market, maybe it's not as obvious just yet. But I think you can see today, for instance, that European stocks are rising, and maybe some optimism over the talks are feeding into that.
Right, because on the Fed front, we're all looking at the weekly jobless claims. But is there a world where this does change, the debt ceiling, it does change folks' expectations for what the Fed does?
I think for sure. I think what's happening right now is that people are not yet that pessimistic about an actual, default. And because of that, people have focused on still resilient U.S. data, as well as, those stickily high inflation numbers. And that's actually why markets have actually started pricing in, increasingly a rate hike coming in, next month or the month after that. And we've seen Treasury yields react to that. But if there is a default, then I think immediately people are thinking recession. That obviously changes the picture.
Oh, yeah. Let's hope we don't get there, because we will be very busy that day if it does happen. Justina, thanks so much for joining. That's Bloomberg Markets reporter Justina Lee. Now, Nobel Prize-winning economist Paul Krugman has downplayed the concerns about the U.S. government's burgeoning debt ahead of a potential default next week. But he told Bloomberg's David Weston current economic policies risk undermining America's future prosperity.
The thing that concerns me most, partly we're just talking about the functioning of the government, right? We're talking about being able to get some money on the line. With the Social Security administrative costs, the IRS. It's not just that we're giving the IRS resources now that will help it crack down on tax evaders, and that's one of the things Republicans want to cut. The other thing is, if you have a question or a problem with your taxes, it's gotten suddenly a lot easier to get hold of somebody at the IRS, which was, still is to some extent, in desperate straits. But what really bothers me, where we are right now, is that the programs that apparently are sacrosanct are programs for the elderly. Medicare, Social Security are off the table. They're being protected. And a lot of the stuff that's discretionary is really things like programs that support children, that support education, that support nutrition for the young, which is the future. So what's happening right now is that in the effort to hold down headline spending right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
So that is a terribly important and very unpopular point, going back to the politics for a moment here, and that is when you say, let's cut things for the elderly. That's not very popular. I'm elderly at this point. But at the same time, we're not really investing in future growth, as I understand it, by paying more, for example, on Social Security, whereas investing in education or children or infrastructure could increase the future growth. To what extent do we need to be concerned about growing ourselves out of whatever debt issues we have?
Well, to a large extent, that's going to happen anyway. I mean, when I say you need to adjust for inflation, you really also need to ask about growth. And, the example I always like to use is, how did we pay off the debt from World War II? And the answer is we didn't. We had slightly higher debt when John F. Kennedy took office than we did on, when we declared victory over Japan. But the debt had dwindled. It was less than half the share of GDP that it had been at the end of World War II, because we had a growing economy and a little bit of inflation over that period. And that's largely, we're still in a world where we really are already set to, if not exactly grow out of our debt, at least not have it grow very much, uncontrollably, unless we do, some really even more irresponsible things than we do now.
Nobel Prize-winning economist Paul Krugman speaking to the anchor of Bloomberg Wall Street Week, David Weston. Coming up, one of the City of London's most senior Black professionals says more radical change is needed in the Square Mile. We're going to discuss that next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
ceiling deadline closes in.
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling. They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. London's financial services industry needs more radical change on racial equity. That's the call from one of the city's most senior black leaders. The remarks from Richard Iferenta come as black workers say the momentum for change has stalled in recent years. Olivia Kanotea-Hulu, our equality reporter, joins us for more. Olivia, how optimistic are black professionals about change in the city?
I think there's really a range. So on the one hand, people are happy that George Floyd and the Black Lives Matter movement really put, those tragic events put these issues on the agenda in a way that they weren't before 2020. But there is a sense that there was such kind of intense commitment and pledges and feeling towards it in 2020, and that has now faded, and now that momentum has been slowing down.
This is such a simple question, but probably the most complicated of answers. What are the solutions?
Well, I think, there's a range of things that can be done. But I think one really interesting point people talk about is culture. So there's a lot of efforts to bring people in and on recruitment. Then there's a sense of how long are people going to stay for? How good is retention going to be? Because if you don't change company culture to make sure that people have opportunities and thrive within companies, then what's the incentive for them to stay?
So what are some of the key barriers? I mean, you mentioned culture, which is obviously a huge one, but what are other ones that people are seeing?
I think the issue at the moment is that the macroeconomic environment has been really challenging. So that means that some of these measures have kind of been, I think, deprioritized a little bit, is the sense that I've been getting. So I think it's just the issue that with things like the war in Ukraine and the cost of living crisis, it's just that it's less kind of high up on the agenda. And I think that's kind of some of the challenges as that trickles down from the top potentially to the lower level.
And was that the same with COVID? I mean, is this just keeps coming up as an excuse?
Well, it's interesting because the Black Lives Matter movement and George Floyd's death happened in COVID. Yes. Some people say that kind of really intensified the whole thing. But the issue at the moment now is that because about 3 years have passed now, it's almost 3 years to the day since George Floyd was killed, that people are starting to say, what about other demographics? What about other groups? Should we just be focusing that much on black people? But as one person said, the evidence isn't showing that the disparities are closing when it comes to black people specifically. So, it's still worth addressing.
Absolutely. Olivia, fantastic reporting. Really appreciate you joining us today. That's Olivia Kanotea-Hulu, our equality reporter. Now, we're going to be covering all things all UK every week. That's on Thursdays at 9:30 a.m. London time in our half-hour special. So be sure to tune in for that. Now let's get to your Bloomberg Business Flash with some of those top corporate stories. Is Alex Morgan. Good morning, Alex.
Good morning, Danny. Bloomberg has learned that UBS and Credit Suisse are offering a rare incentive for their wealth bankers in Asia. Relationship managers will receive a commission of 15 cents for each $100 of new client money they bring in. The move comes as these Swiss banks look to ensure stability as they seek to complete their merger. Alibaba says it plans to hire 15,000 people this year, pushing back on reports that the firm is laying off employees. The Chinese e-commerce giant described reports of layoffs as rumors and said employee departures are part of the normal flow of the business. And Bloomberg has learned that the TSMC is in talks to receive German government subsidies for up to 50% of the costs of a new factory. Our sources say the negotiations involve a plant in Dresden to be built at an estimated cost of close to $11 billion. The top end of the subsidies being discussed are similar to what Japan has offered TSMC. That is global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you very much. Coming up, it keeps getting worse for Carl Icahn. Another 25% drop in Icahn Enterprises shares is raising questions, including the big one: how is the billionaire going to get out of this? We'll be discussing with our hedge fund reporter next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Human Capital Management founder and CIO Kyle Bass, who has been predicting serious pain in the U.S. office market, is taking a different view towards data centers. His remarks come after chip maker NVIDIA surprised analysts with a bumper revenue forecast, propelling a surge in AI-related stocks.
The one thing that I see from the macro perspective is everyone thinks commercial real estate, is in the tank, and it's really just focused in the office market. When you look at the data center market, it is white hot. People that are developing data centers don't even get them developed before one of the FANGs leases it for 30 years. So I have a friend that has 13 data centers that they were developing all over the country, and in one phone call, did a $3 billion, multi-decade deal with one of the FANGs. They just leased the whole portfolio. So data centers are white hot. NVIDIA is white hot. And as you know, we're building, TSMC's building both a 5-nanometer wafer fab and a 3-nanometer fab in Phoenix. We've got Samsung building in Texas. We've got Intel building in Texas. The U.S. is reshoring, onshoring this high-powered chip business, and NVIDIA is leading the way, first with their GPUs, their gaming chips, and now their generative AI stuff that is just, again, white hot. I wouldn't short NVIDIA. I think it just has a long way to run here.
When you talk about a long way to run, how should we be thinking about this? Is this a generational shift that we're experiencing here, Kyle? In 2000, we had to have a massive clear out before we figured out who was going to actually be top dog on the internet. Turned out to be Amazon and companies like that. Are we going to have to see something similar here? We're going to get a lot of people coming at this from different angles. How do we clear out and figure out who's going to be the winner, who's going to be the loser?
Yeah, again, I look at this from a different perspective, especially on the losing side. I keep reading everything from Wall Street telling me that AI and generative AI is going to be jobs positive. Mm-hmm. I just have an impossible time believing that. We've got 3 million plus, let's say, service workers that run cash registers or front ends of businesses in the U.S. We've got 3.5 million truck drivers. I can look through the businesses that I'm fairly certain we're going to see millions of job losses in. And I don't think you can train those specific people or retrain them into, let's say, the high-tech market. So I'm worried about the long-term job possibilities. I mean, just think about how many pilots are out there, and really, how many pilots are we going to need when we get real? Let's just say, right now, the big planes essentially fly themselves. So we don't need the big crews that we've got. Anyway, I think about how many jobs are going to be put out of business as this.
So Kyle, so to that point,
So you're thinking, okay, AI is this huge trend. It is a structural shift. It's going to have big implications for the job market, the economy, and productivity. Do you play that? Do you trade it? Is this like you mentioned, you go buy data centers? Like, how do you capitalize on this sort of evolving trend?
Yeah, I mean, developing data centers, owning public data center stocks, securities. I mean, that again, that has given ChatGPT and the amount of compute that's taking on the back end. I hear that Microsoft and Amazon and the rest of the cloud providers are struggling desperately to keep up with the amount of compute that's going on with ChatGPT. And again, that's only going to grow exponentially as AI gets stronger.
That was Heyman Capital Management founder and CIO Kyle Bass speaking to Alex Steele and Guy Johnson. Let's get you your first word news now. With that is Alex Morgan. Alex.
Good morning, Danny. Well, we start in Turkey, where the central bank has kept its benchmark rate on hold at 8.5% for a third month in a bid to stabilize the lira. The policy decision comes ahead of Sunday's election runoff. President Erdogan is looking to extend his 2-decade rule after leading the first round of voting, but failing to take 50% earlier this month. Bloomberg has learned that UBS and the Swiss government haven't agreed the precise terms of the state guarantees for the emergency takeover of Credit Suisse. Sources tell us the deal's completion could be pushed back to June instead of late May. While UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. And Siemens Energy says it's experiencing a surge in demand for green transition technologies. That's as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, CFO Maria Ferraro says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Well, it's Global News on your Friday morning, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you very much. It keeps getting worse for Carl Icahn. Shares in Icahn Enterprises plummeted as much as 25% yesterday, closing at the lowest level since 2009. The billionaire's personal fortune is also dwindling. That slump alone has cost him $979 million. It's just one more bad day in a weeks-long run of them for the legendary lone wolf of Wall Street since short seller Hindenburg Research trained its sights on him. The questions keep coming, including the big one: how is he going to get out of this? So let's ask that big question to our hedge fund reporter, Nishant Kumar. Nish, how is he going to get out of this?
Well, first of all, let's not forget that he's still very, very rich. Despite some 16 billion blown away, his net worth is still more than 8 billion. The problem for him is that he has borrowed billions of dollars against his stock in the company, which could lead to margin calls if the stock keeps falling like this. We should not be giving investment advice to a billionaire, but one of the options he has that he can buy back the shares, he can go private. Remember, he still owns, and he owns 84% of the company, and the stock has crashed by 60%.
It's probably worth doing a little bit of hedgy history here. Bill Ackman was tweeting quite a bit. Excited by this whole event? Why, Nishan? What is it about these two?
Well, indeed, there is no dearth of friendship between the two famed activist investors. Let me remind our viewers here that Ackman famously fought with Icahn a decade ago over Herbalife and ended up losing a fortune. Now he keeps roasting Icahn on social media. He has even said that the company reminded him of Archegos, the family office of Bill Hong, which was blown away, collapsed last 2021 because of his leveraged bets.
Yeah, amusing to see that play out on Twitter. Nishan, there's a little bit of irony here, because here you have a famed activist investor who usually goes into companies and tries to change something, and we have that type of targeting investor becoming a target himself. Has that happened before? How rare is this kind of thing?
I mean, so there are not too many activist investors listed, but we have seen increasingly Third Point, Bill Ackman's own firm has a listed vehicle as well. So this is not for the first time. Again, let me remind our viewers that in 2021, one of the biggest shareholders in a London-listed fund managed by Dan Loeb, Third Point, launched a public campaign demanding changes there. And just last year, a London-listed money pool linked to activist firm Trine said that it will return clients' capital and close after months of wrangling with their investors on how the fund is run. So it's not the first time at all.
When it comes to the Hindenburg accusations, what are they actually, Nishan? We've got about a minute here.
Yeah, I mean, it's a list of acquisitions, but Anderson, who recently very famously took on India's Adani Group, has accused the company of costly missteps, lousy performance, and above all, dramatically high overvaluations. So basically, he's saying that the company is traded at a higher price than the value of the underlying assets, which is not normal in this year. Normally, closed and listed funds trade at a discount because you can't exit them quickly.
Okay.
Of course, ICANN has called this allegation self-serving and vowed to fight back.
Yes, absolutely. Hey, Nishant, thank you so much for that. That is Bloomberg's Nishant Kumar. Bloomberg Surveillance Early Edition. It continues in the next hour. Kriti Gupta is in New York. Tom McKenzie here in London. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. We had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Hurdling ahead, Republican and White House negotiators are making progress towards a debt ceiling deal, which is said to include capping federal spending for 2 years. Tech shares remain in focus amid the frenzy for AI stocks, but investor Cathie Wood is missing out. Her flagship ARK fund dumped its stake in NVIDIA right before the chipmaker's blistering $560 billion surge this year. And Ford strikes deal with Tesla in a rare partnership among rivals, giving its customers access to the largest, fastest, and most reliable network of EV chargers. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, stepping in, of course, for Anna Edwards temporarily here in London with Kriti Gupta in New York. Kriti, there's a little bit of optimism across European equities this morning, but once again, investors here held hostage by the news coming out of DC.
Absolutely, and that becomes kind of where the focus starts to shift a little bit on some of the fundamental stories. And note, I said just a little bit. You are seeing futures virtually unchanged here, Tom. Essentially this idea that as Washington puts you in a stalemate, do you buy in to the hype that you are seeing in the tech space? Not just the AI-driven rally in NVIDIA and some of its peers. We're going to dive into that in the rest of the show, but some fundamental stories as well. The Tesla story that you just talked about, the idea that the world is changing, tech is becoming a bigger part of our lives, but is that enough to really incentivize stock market investors? At least in this morning's trade, it doesn't quite look like it. Futures really set unchanged, 41.56 on those contracts. The two-year yield, though, continues to surprise to the upside, 450, almost 450 on the front end of the curve, getting very scarily close to the 5%. I love to round up, kind of like when you're young, you round up to the age that you really want to be at. Two-year yield at 449, coming down a little bit in this session. So really watch the technicals here because, again, as you say, Tom, the debt ceiling debate is really what's going to be driving the bond market, at least as we get closer and closer to the X8. The last Friday before we head off into the long weekend stateside, and Congress apparently does not work the long weekend. So something to keep an eye on. The Bloomberg Dollar Index down about 0.2% following the yields picture, but inverse, you get the commodity picture a little bit higher. That kind of dollar weakness perhaps giving a little bit of a tailwind to NYMEX crude trading, Tom, with a 72 handle.
Yeah, it's interesting. Commodities, we're seeing a big tick up in terms of iron ore prices and copper prices, so reversing a bit of a trend that we've seen this week, and that's lifting the sector, basic resources across Europe this week, or at least in the session today, I should say, and the FTSE 100 benefiting to some extent from that. You're flat though now across the FTSE 100. Across the European benchmark, very, very modest gains. Again, part of it is down to investors waiting to see what happens in terms of that debt ceiling debate. And of course, in the UK, the focus is on what's happening with yields because they continue to run up. And the focus as markets start to price in maybe 5.5% in terms of the Bank of England, with the Fed, of course, in focus as well, repricing and the PCE deflator indicator out later today. Across some of the individual names, we can change on the board then and see how things are shaping up. There's a couple of individual corporate stories that are of interest in terms of what's playing out here. Rio Tinto, again, talking about the basic resources story. Rio Tinto being revised higher by analysts in terms of their price targets for this stock. Morgan Stanley pushing up their rating on the company because they say that its copper holdings are underappreciated, and that ties into that EV story that we were talking about. Tesla, Ford, EVs, of course, copper central to that, and Morgan Stanley saying that's underappreciated as a stock, and it's rallying today in the session. A very different story, though, for Casino, which is a major owner of supermarkets in France. If you've ever visited that country, it may have been a place you popped in for a box of croissants and some foie gras. It's currently down about 8.4% because they're in negotiations with some of their creditors. The stock was suspended on Monday, retrading again today, and pressure on that stock as they look to sell off some of those supermarkets. Again, across the benchmark, modest gains of 0.2% here in Europe. Kriti.
And of course, to your point, Tom, even as we watch those micro stories, the macro still surrounding the Washington debate around the debt ceiling. Republican and White House negotiators are moving closer to an agreement to raise the debt limit as they try to avert a U.S. default. Nobel Prize-winning economist Paul Krugman spoke about his concerns yesterday.
What's happening right now is that in the effort to hold down headline spending Right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
Joining us now is Bloomberg economy and government editor Jill Deese. Jill, it looks like we're getting closer to a deal. It's starting to see some of the cracks kind of getting closed, but what kind of progress have we made? Are we going to make the X date?
Well, Kriti, it seems like we might actually make it. I think that what we're seeing is potentially a deal that's put together by the Republican negotiators and the White House negotiators as early as today, Friday, in Washington. Now, while they haven't agreed on the amount that they'd be putting under this cap, it does seem like they're moving toward agreeing to plan to raise the debt limit and cap federal spending for 2 years. There's some provisions that are still being discussed in terms of energy grids. We've got some fossil fuels discussion in there. So all of the details behind that, including, as I said, the amount still has to be worked out. But ultimately, it does seem like there could be something that goes to Congress as soon as Tuesday. And then that would set us up, if that is able to get through, for something that puts us in deal. It gives us a deal before we actually reach that X date.
I wonder, Jill, if not in the US then elsewhere, whether the spending caps that are going to come through as a result of these negotiations are being overlooked, at least underpriced by markets.
Yeah, Tom, so I think that ultimately we need to see what the details actually are for these spending caps. And I think that that's probably what markets are looking for, right, is this more details. I mean, we're sort of in this weird flux zone right now where while it's somewhat optimistic that we do have some progress here, at least compared to where we were earlier this week, we at least have an idea of how long the spending cap may be. Remember, again, Republicans were originally looking for something as long as 10 years. We still don't know that total amount yet. We still have to see how all of this breakdown looks like. So hopefully we'll have something that gives us a little bit more insight into that by the end of Friday. And then maybe that's something that investors can actually look at as they're trying to price in how exactly this could have bigger impacts on the economy going forward.
Jill Deese is covering all things of the debt ceiling for us. We thank you, as always, of course, watching that very, very closely. But at the same time, we're watching the consumer, the underlying U.S. economy, with warning signs already flashing on the health of that spender. Quarterly earnings from big box and budget retailers this week give us insight into the depth and duration of the economic slowdown. Just a couple of names, Costco and Gap, rounding out the earnings season at yesterday's close. Joining us now to walk us through it, Bloomberg's Simone Foxman. Simone, a mixed picture from Gap and from Costco.
Yeah, Costco came in pretty weak, but a lot of the drag on the earnings per share, about 50 cents drag, was based on its ending its container shipping business. So that, I think investors reacted to that, and then they looked through the earnings and were a little bit more optimistic. But overall, Costco reiterating some of what we heard from the other big box retailers. People are spending less when they are coming into stores, and Costco specifically focuses on a pretty high-end segment. So that was sort of an interesting data point. Also, an interesting data point out from Gap. Shares did pretty well after the company beat a lot of estimates, but there was a very low bar among analysts. This is a company going through a turnaround story, and we've seen a really mixed bag in apparel over the past couple of days. Again, companies beating really low bars that executives set, but also this idea that there's not a recession yet, so people still are spending on some of this stuff.
And Simone, what are we hearing from executives, from leaders of these businesses? How much concern have they been expressing?
Well, there's definitely the sense that consumers are softening, but they may not be cracking yet. There are still things they want to spend on, and a lot of those things are related to what they've experienced over the last couple of years. They've had to stay home over the course of the pandemic, and now they're continuing to spend on things like beauty, like apparel when they go out, but not necessarily on things like home improvement. There's a little bit more strength when we look abroad, but this is specifically on the U.S. consumer. And so they're pulling back on things like groceries, where they're turning to sort of the private label items. They are delaying some of their long-term home improvement projects. You know, one of the other things we've heard from a lot of executives has been about shrink and read theft in this. This seems to be an ongoing problem for a lot of, an increasing problem for a lot of these retailers. Again, the economy looking a little bit worse for the consumer, but we're not yet hitting this wall. We're not yet hitting this recession.
Simone Foxman, all about the consumer story. As we're getting mixed signals, we're going to have her posted on those developments. Meanwhile, across the Atlantic, Turkey's central bank has extended its interest rate pause for a third month as it tries to keep the lira stable. This policy decision comes just ahead of the country's presidential runoff this weekend. Bloomberg's Yusuf Gamal Eldin standing by, joining us now. Yusuf, walk us through why this is important.
Well, this is not just about a repo rate that stays at 8.5% as expected. This is about a central bank doesn't want to appear like it's taking sides. It's about inflation at 44%. That kind of raises the stakes for the runoff on Sunday. Remember, in the first round of the presidential election, we had the incumbent president Recep Tayyip Erdogan. He got 49.5% of the vote. You had his most credible threat, Kemal Kılıçdaroğlu. He came in second. And the third was Sinan Oğan, who has now endorsed the incumbent president. Erdogan, who's made quite a bit of a name for himself in terms of high borrowing costs that he's pushed down. He's ruled out rate hikes for the future. And that's the bigger issue, is what happens in the post-election world. And regardless of how this pans out, they're going to have to return to a relatively sustainable path of orthodox monetary policy, guys.
Yeah, wow, 40%, what, plus 40% inflation. Thought it was bad here in the UK. Talk to us about, is tourism a bright spot for Turkey? Is a weak lira proving attractive for tourists?
I mean, Tom, I was there, 10 days ago, and it was as busy as ever. They have this brand new airport. They do about 55 million passengers a year, and the latest numbers underscore the resilience of tourism in Turkey. I mean, we are up 29% on the year. That is in the month of April. You were up 12.3% in the month of March. As much as foreign currency inflows are still very much there, because the central bank has been intervening on a regular basis to try and prop up the Turkish lira, they have a net negative international position, which hasn't happened in 21 years. It gives all economists out there a lot to work with in terms of case studies and analyses, guys.
Yeah, indeed, probably for years to come. Yusuf Gamal Eldin, thank you very much indeed for the preview, of course, and that runoff this weekend. Coming up, Christian Kopf, Head of Fixed Income and FX at Union Investment, joins us. We'll get some calls there on how to position within these fixed income markets. And later, we're going to speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. Is the rally in tech overdone at this point? Plus, Tesla and Ford forming a rare partnership for their EV customers. More details on that still ahead. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Look, it's all about the debt ceiling debate, and you're already seeing it getting very clearly priced into the markets. But what's the trade here? Do you hop into the bond market at a time when the full faith and credit of the United States is at risk? And in some ways, yes. And here's why. One of the reasonings, or one of the cases to do that, it comes down to the real yield, because you're starting to see U.S. real yields actually rise. That was one of the big issues that essentially with the kind of onset of inflation, yields weren't giving. And that's really where you start to see that reverse. You're seeing 248 on the 2-year TIPS yield, the highest going all the way back to the global financial crisis. That is a big deal when it comes to whether or not you want to hop into the bear. Is that a fair trade to make? Let's say we do actually get closer and closer to this exit. In these next few days, what's the attractive trade?
Yes, Kriti, I think that this is a pivotal time we have right now. We've got, the debt ceiling discussion, which likely will come to some form of a conclusion today or at the latest over the weekend. And then we have inflation numbers coming up and the decision whether the Fed will do one more hike or another 1 or 2 more hikes. Now, when we look at what you mentioned here in the U.S. bond market, we see two things. At one hand, we see upward pressure here on the nominal yields, which come from a decline in risk aversion as the market is pricing out the risk of a sovereign default in the US. At the same time, you've got these relatively elevated real yields. On the 2-year sector, you've got a 2.4%. In the 10-year sector, we've got around 1.5, 1.6% real yields. These levels are already quite attractive. And I think very soon we will see a situation where people will start to receive those yields.
Christian, so that's the short-term play. Let's talk about the long-term play. The latest developments out of Washington essentially suggests a federal spending cap of about 2 years. That's good news when you're getting closer to those debt ceiling agreements. But Christian, in terms of growth, when you're seeing a lack of government spending directly affect GDP, are you at all concerned about the fact that that lack of catalyst from the U.S. government is going to hurt America's GDP? How do you view that?
Frankly, I'm not that concerned. I think that the spending caps, the caps on non-defense spending that will likely come out as an agreement today should not have a material impact on economic activity in the United States. There will be ways to circumvent those spending caps, and I don't think that the magnitudes we're talking about here should have a material impact on output. So I don't think that this is a reason to be concerned about economic activity in the U.S. You know, we are in a situation where the first quarter GDP growth was much stronger than expected, and overall employment growth is still relatively robust in the U.S. So if anything, it's probably a good time to take back some of that fiscal stimulus in the U.S. Yeah, so I don't think that's the reason really to go along here, the bond market. I think the reason to go along the bond market is the fact that we already have relatively high real yields, especially compared to other regions in the world. I mean, the numbers that you've shown here on the 2-year real yield in the US, and then you've got the 10-year real yield at around 1.6%, they compare quite favorably to other regions of the world. In Europe, the real yield on the 10-year sector is close to 0.
Hey, Christian, there's a scenario by the end of the next week, we have a deal on the debt ceiling. We get the PCE deflator out later today. The expectations are it's going to actually tick up from the previous month. We saw those jobless claims being revised lower yesterday, a reminder of the strength of the labor market, at least relative in the US. There's a scenario by the end of next week where June is going to be looking like it's locked in for the Fed. Would it be hyperbole to start, questioning whether or not this Fed may even be looking at 6% by the end of this year?
Well, you're coming back to the 6 is the new 5 discussion, no? That was a discussion we had in February this year. There was the U.S. Monetary Policy Forum in February in New York, and at the time, 6 is the new 5 was making the rounds. Now, I don't actually think we're going back to 6% or discussion, the 6% overnight rate here in the U.S. I could see a scenario where the Fed will hike in June. That is our long-held call. Some will depend on the inflation numbers we will get on the 13th of June. But overall, with the specter of sovereign default dissipating, relatively strong economic activity numbers, stubbornly high inflation, relatively strong labor market, our call is still that the Fed will continue to make at least one more hike in June. But I don't see the Fed going to 6% here, no. I mean, for that, the conditions are not in place. And keep in mind, we do have disinflation in the US now. It is actually stronger and faster, the disinflation, than in Europe. So I think that one more hike, should probably do it for the Fed, and then they will start to wait for those disinflationary forces to play out.
Well, there you go. You point to the divergence between the US picture versus Europe. I know you've got your ear to the ground when it comes to policymakers at the ECB. 375 is where the benchmark is now for the European Central Bank. We had a reminder, though, of the weakness coming through from Germany and that economy earlier this week when it fell into recession, of course, for the first quarter. How far can the ECB push it, given the fragility that we're seeing in economies like Germany now?
Well, first of all, the shallow winter recession we have had in Germany, 2 quarters of negative GDP growth, were related to the very high energy costs. And we can now observe a fast decline in energy prices. I mean, if you've got the TTF contract for the natural gas in Rotterdam trading below 30 euros on the megawatt hour. So we see a rapid decline in energy prices, and that is very helpful for the companies and also for the consumers. So that should help economic output, also actually helps the current account position of Europe. Second, we have relatively robust growth still in other countries of the euro area, especially in Italy, but also Spain. So Germany is not the only country out here. Third point has to do with interest rates. I mean, I think that it's fair to say that we already have a contractionary monetary policy in the US, a very tight monetary policy with an ex-ante real interest rate of around 1.5% to 2.5%, depending on the tenor that you choose. We don't have that in Europe. Our ex-ante real interest rate on the inflation-linked bonds is 0. So I think there the ECB still has a ways to go. And then also, I think that the wage dynamics in Europe, there is still a lot of catch-up growth to be done here in wages. People have seen a decline in their real income over the last year because of the very high levels of inflation. And we see wage settlements slowly creeping higher in the euro area. So there is a case to be made that the ECB should continue to hike. And that's actually what we believe.
Christian, in that scenario then, talk to us about how the interest rate differentials kind of come perhaps in conflict with some of the positioning around the debt ceiling that you're seeing in the dollar.
That is a very good point, Kriti. So we actually do have that conflict. I think right now, if the debt ceiling problem gets resolved, we could see euro-dollar move to 105 because, the risk aversion is being priced out of the market. But actually, our call is still for euro-dollar to move higher by the end of this year. And that is driven by those differences, the divergence in the monetary policy. We do expect much more rate hikes, if you wish, from the ECB than from the Fed in the second or in the summer this year. So that should, over time, help to drive the euro higher. Now, there's a debate about how much the ECB will do. I'm just here in Dubrovnik, Croatia, attending the national conference, the annual conference of the National Bank of Croatia. We just had a presentation here by Philip Lane. The slides from his presentation are available on the ECB website. And he's pointing out to a lot of disinflation forces which are at play in the euro area. But there are other people here in the room, people from the BIS, people from other central banks, who argue that actually inflation could be much stickier and that we may be moving away from that low inflation regime that we've had in Europe for 20 years or so. And that is a cause of concern for many central bankers in the European Central Bank Governing Council. So I think that there is a debate really on how sticky inflation is and whether it will come down in the way that the ECB is forecasting.
Christian Koff over at Union Investment, making time for us in this very busy day. We thank you, as always, for your time and for your insight. We want to keep you up to date with news from around the world. Here's the first word. Bloomberg has learned that UBS and the Swiss government haven't agreed to the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. Siemens Energy says it's experiencing a surge in demand for green transition technologies as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, CFO Maria Ferraro says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Alibaba says it plans to hire 15,000 people this year, pushing back on reports that the firm is laying off employees. The Chinese e-commerce giant described reports of layoffs as, quote, rumors, and said employee departures are part of the normal flow of the business. Tom, your take on this Alibaba story at a time when it feels like a lot of the world is dealing with an extremely tight labor market.
Yeah, indeed. And of course, this is a sector that's been under pressure as a result of the regulatory squeeze, and officials have come out and said, do you know what, we're going to support the tech sector now. But there's a political angle to this as well, which is that companies like Alibaba, they don't want to be seen to be laying off huge numbers of workers. It doesn't play well with, of course, their patrons, particularly at the state level or the provincial level. So there's that part of it as well. But the interesting story at the corporate level is they're looking to spin off about 6 of their divisions, the logistics part, but also the cloud division as well. So a major restructuring underway overall for Alibaba.
And how does that square then with some of the, perhaps the regulatory kind of deal when it comes to Alibaba? When I think Alibaba, I immediately think all the controversy around Jack Ma. Where are we on that?
Yeah, Jack Ma has kind of been revived to an extent. He's still keeping his head down, but we've seen him appear now in mainland China. So he seems to be on surer footing. And they've got the blessing, it seems, to do these spin-offs. In fact, they're being encouraged to do so because there's always been this concern amongst regulators about the oversized power and play of some of these tech companies. So they seem to be getting the back of that. And again, investors, Anna, say, look, you can unlock a lot of value here. Again, on the jobs front, the context is there's about 20% unemployment amongst China's youth. So there is that as well to bear in mind. It's pretty scorching in terms of the unemployment pressures there, and they don't want to be playing into that.
Yeah, it's pretty fascinating. I love to look at the Alibaba story because even though we kind of group it in the tech story, Bradley and Tom, of course, you're an expert here in this. The idea that at some point they actually did want to build out that financial arm is fascinating. Yeah. It's kind of the American equivalent of if, say, Apple wanted to build out a bank, for example. I'm sure that's a little bit of a stretch, but that's the way I think about it.
I don't think that's a good analogy, and I think we definitely need to keep an eye on what happens with Ant Financial, whether they revive those IPO plans, of course. That is definitely one to watch. Now, coming up, we're going to speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. We'll keep an eye and a finger on the pulse on tech, get his views on this AI-fueled rally that we've seen. NVIDIA, does it have further to run? Jay Woods coming up. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government if the president called you to serve our country?
I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Hurtling ahead, Republican and White House negotiators are making progress toward a debt ceiling deal, which is set to include capping federal spending for 2 years. Tech shares remain in focus amid the frenzy for AI stocks, but investor Kathy Wood is missing out. Her flagship ARK fund dumped its stake in NVIDIA right before the chipmaker's $560 billion surge this year. And I'm Kriti Gupta in New York with Tom McKenzie, stepping in for Anna Edwards in London. Tom, a lot going on the macro front, a lot going on the micro front as well, but the debt ceiling still the focus all around the world.
Yeah, and some of that temporary relief that came through in the European session has come off now. So you're flat across the European benchmark as investors kind of look for the next catalyst and wait on that deal to come through, if indeed it does materialize. Euro dollar currently gaining 0.1%. Of course, the Bloomberg Dollar Index is off in the session. A couple of individual corporates to bring to your attention. Rio Tinto has been upgraded by Morgan Stanley. It says that its holdings of copper are being undervalued by investors, and that stock is gaining on the back of that upgrade from Morgan Stanley, 3.5%. It ties in, of course, to the shift and the repositioning around electric vehicles. And in the supermarket space in Europe, particularly in France, Casino is embroiled now in discussions with some of its debtors. Are going to have to sell off a number of its supermarkets. That stock, after being suspended on Monday, retrading again today, taking a hit down 7.8%. Kriti.
Yeah, seeing a little bit of pain on the micro front there. Let's go back to the macro, zoom out a little bit, Tom, because stateside futures virtually unchanged. I mean, you're seeing down about 0.2%, so a little bit of sentiment souring, but this makes sense. It's a Friday. There's a long weekend coming up stateside, not to mention the X date getting closer and closer. So to see that to the downside, not that much of a surprise. Does it turn around, though, as we get developments, perhaps before the long weekend, which I'm told Congress is not working. The 2-year yield is something to keep an eye on as well, because, again, as sentiment sours, a bid into the bond market, 448 on the front end of the curve, lower by about 4 basis points, and with it taking down the dollar. And that's going to be a really interesting story as, again, we talk about simply what is driving the dollar story, given there's so much speculative positioning in the greenback, despite the debt ceiling concerns. Of course, NYMEX crude, the ripple effect of the dollar largely showing up there. That's where you're seeing a little bit of sentiment change. Still trading with the 72 handle, Tom, but a little bit stronger since what we checked in about 30 minutes ago.
Okay, let's get back to what was at least a key driver for these markets yesterday, and probably will continue to be so in the weeks and months ahead, which is, of course, AI, and particularly the focus yesterday on NVIDIA. Let's bring in Jay Woods, Chief Global Strategist at Freedom Capital Markets, to talk all things markets as well. But let's start with tech, Jay. Good morning.
Hey,
Thanks for joining us. And the story that we have is very well read on the Bloomberg around ARK, of course, Kathy Fund and the main fund selling out of NVIDIA earlier this year, so not benefiting from the upside that we've seen in the last couple of days, the last few weeks for that stock. How much of a critique is that of the ARK strategy?
Yeah, I'm not here to be critical of the strategy. I mean, last year they sold out of Twitter, and that would have been the biggest winner in the fund as well. It's struggled lately. It was down 81% peak to trough, but I'm seeing some progress there. You want to look under the hood. Some of the stocks within the sector have been acting much better. You look at Exact Sciences, DraftKings, we're seeing, and Shopify, those are 3 that are starting to turn. And then it's been basing. You've seen the stock go sideways, up 30% year to date, and it's recaptured that 200-day moving average. It tricked us once, it did that before, but let's watch this level closely, because I think if the small caps start to turn, if AI becomes more of a story and tech follows it from there, she's got some good product in the fund, and we could see it take a nice leg higher. Is it going to be euphoric like it was the last time it ran up? No, but there is a lot to reverse here, so there's progress being made.
Jay, does this AI story have further to run? How do you want to play this? We were speaking to guests earlier on Bloomberg TV saying, look, there's a risk that you get sucked into some of the frothier, some of the boomier stuff, not looking at the industrial play around AI. Is that the way to position?
Yeah, I mean, NVIDIA had a day of all days, and that guidance was something I've never seen in my experience here. That was just phenomenal. So I think there is more room to run. The semiconductors have been strong all year. There's a lot of strength. There's semiconductor stocks breaking out of large bases, Micron being one of them. So I think this is a story that's here for a while. There is a euphoric sense to it that gets me a little concerned that we go out too far above our skis and we could see some pullbacks. But this is a story that's not going to go away anytime soon.
So, Jay, that is the defensive kind of trade, almost the beta play of it, which, by the way, we should say that one of the tailwinds is also coming from the debt ceiling story, the macro story. If you're worried about a recession around the corner, you go defensive, right? That's something we've been hearing from a lot of guests on Bloomberg Television and radio. But then there's the other side of it. If you're worried about recession, you're worried about small caps. Are you?
Yeah, I mean, small caps have been the laggard all year. And we look at the Russell 2000, and what are we seeing? We're seeing, you know, sideways action, but we're seeing higher lows. It's at a very critical level right now, testing its moving averages, testing its recent uptrend line going back a few months. Like the market, it's kind of stuck in that position where we're going to break one way or another. If we can get a break to the upside in the Russell, and historically, this is a seasonal period where we see some strength as we go into the Russell reconstitution, which will be later in June. We tend to see a little bit of a rally. So I'm hopeful, and hopeful is the key word, that this trend continues, and the small caps, if the regional bank crisis can abate a little bit more, can bounce back and be a strong contributor in the second half of the year.
Well, it's an interesting dynamic that you're seeing in the Russell. And before we move forward, I want to tell our international audience specifically that you've been on the floor of the New York Stock Exchange for, what, 30?
31 years,
31 years. So you have seen the highs and the lows. Talk to us a little bit about the breadth here of the market. One of the big concerns is simply that this is a tech-heavy market. To me, it feels like you need both the Russell and the NASDAQ on your side for this to be sustainable.
You do, and it's one thing that we talk about that's a little concerning right now. The breadth has not been there. It's 10 stocks leading us up, but it's the right leadership. When you're looking for things to turn, you want tech to lead. Now I want to see the financials find their legs. It looks like that May 4th, May 5th washout that we saw in the regionals and some of the larger banks may be the lows. If that is the case, the Russell will slowly come back and we'll see a broadening of the breadth. That is the one thing that has me concerned. But right now, consistent higher lows with a base or a resistance level at 4,200 in the S&P 500. We may break above, and then the Russell here, the 200-day moving average. There's some constructive things happening under the surface. I'd just like to see it broaden out a little bit more.
Hey, Jay, look, we know the connection between higher yields and financials and the prospects for the banking sector. Higher yields and tech, that's not meant to go together. Is this temporary, that we've seen these yields run up and yet NASDAQ has continued to perform well? Is this a new trend, or is this a temporary evolution?
You know, I think COVID has changed the way we look at everything. You know, I have no idea why, you know, it's not the textbook way of doing things. You know, the tech stock should be getting crushed given the rise in rates, but no, they're not. What people are doing is they're separating. It's not all tech, it's select tech. They're finding the winners, the best in brands. You're seeing it across all sectors where, you know, the leadership is doing well, but that doesn't mean the tide is lifting all boats. We're seeing, you know, very selective trading, and NVIDIA was just, you know, you look at the SMH, NVIDIA is far and above everything else in that sector, and it's starting to lift all boats. But you know, if rates continue to go, if we go 6%, yeah, I think that will have a direct impact on the tech sector, and we should see, at worst, a pause. I mean, at best, a pause, and at worst, a little bit of a sell-off.
You've set me up really nicely, Jay, talking about tide lifting all boats. So cruise lines, this is in your notes to us. This could be a sector that's turning, you say?
Yeah, you know, it was a nice segue. I've been watching the charts of Carnival Cruise Line, Norwegian Cruise Line. I talked about COVID being something that disrupted everything, and we'll look back and we may have an asterisk on how we looked at the economic effects on things. Well, the cruise lines got hit, and you know, like a cruise ship, it takes a long time for these things to turn around. And what I'm seeing are constructive bases, higher lows, and now breaks above some key levels. In Carnival, watch that $12 level. Norwegian, their numbers have been fantastic, and if you look at their numbers before 2019, they're up. They're up 30% from 2019 pre-COVID. So price hasn't followed yet. They have a long way to go, but I'm seeing progress, and the sailing ahead may be smooth, to continue on that pun.
All right, Jay, final question here as we get prepared for this long weekend, the debt ceiling, X date, et cetera. You think it's going to work out?
Oh, I think it's going to work out? Yes, I think it's going to work out. Do I hope it happens before we go away on this weekend? Most definitely. That's the one thing traders don't like, is to, you know, have to be checking their phones, checking the news over the weekend. Coming in on a Tuesday light volume could cause a lot of volatility if nothing's settled by the weekend. Hopefully they can get it done by then.
Okay, watch this space. Jay Woods, excellent. Thank you very much indeed, of Freedom Capital Markets, on this tech sector, on the debt ceiling, of course, on the prospects for these financials. Thank you. Coming up, JP Morgan telling 1,000 First Republic employees they won't have jobs as the takeover unfolds. More on that next. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Now we head to Wall Street, where JP Morgan notified about 1,000 First Republic Bank employees that they aren't being given jobs following its takeover of the failed lender. Joining us now to bring us all the developments, Bloomberg Wall Street correspondent Sonali Basak, waking up early for us and joining us on set. We kind of knew this was coming, right? This happens when there's mergers.
Certainly, when there's mergers, not everyone can come on board, especially with two banks like JP Morgan and First Republic, where there is overlap in terms of jobs. I would also remind you that JP Morgan is one of the banks that really expanded headcount pretty meaningfully in recent years, including in the tough times of the last year or so, where we've seen a lot of banks cut jobs. We know that JP Morgan's headcount has actually expanded over that time frame. Now, remember that this is about 85% of First Republic's job force here that were given either full-time or part-time jobs. One question I have, Kriti, is how many of those part-time jobs become full-time jobs, or do they start to taper off over time? I guess it really depends on what kind of business is brought in from First Republic as the integration ensues.
Yeah, and it's worth saying that JP Morgan spokesperson has said, look, it's a stressful time for them all, but at the end of the day, they are updating the employees on their status within 30 days. So worth bringing that clarity from the bank itself. Let's go to another bank here. Morgan Stanley seeing some job cuts, not stateside, but in Asia. Walk us through it.
Yeah, remember, Morgan Stanley had been undergoing a kind of more global headcount reduction to some degree here. We know they made a small one at the end of last year, then they had an additional one this year. The market has been really soft, particularly in Asia, where deals has not really started to come back. Remember, Morgan Stanley's headcount there was already larger than a lot of global peers. They have a large investment banking workforce there. But what is striking about our report here, Kriti, is that some of these job cuts even extend to people who were promoted in recent years. So that shows you kind of the extent of the pain that the market is feeling, and the unwillingness of certain banks to keep staff on at scale, or at least the scale that used to be, as they look towards what the next cycle starts to look like as deals may start to come back.
And Sonali, meanwhile, in this part of the world, there's some Bloomberg reporting suggesting that maybe finalizing the deal, the takeover, UBS, of course, Credit Suisse, that's going to take a little bit longer because they're having a wrangle with the Swiss government, UBS are, about this backstop.
Yeah, and that is an interesting story, especially on the talent perspective, Tom. We're talking here a lot about this top story here of UBS offering really incentives for wealth managers here, particularly in Asia. You're talking about your part of the world. Remember, there's still a humongous concentration of wealth when you look at China and the broader Asia region here. And the incentive is quite rich, if you will. It's about 15 basis points for every $100 in new client money that can be brought in. Remember that is not usually so specific or even so large when you look at wealth managers, but it just shows you as the deal uncertainty continues on, you have UBS's top brass going to Asia and making sure that they can keep people on in this really uncertain time frame.
Bloomberg, Sonali Basak, all over the global Wall Street story. We thank you as always. Another story that we are monitoring very closely comes in the car maker space. Ford has struck a deal with rival Tesla to give its electric vehicle customers access to the Tesla supercharger network. Tesla CEO Elon Musk discussed the benefits of the deal in a Twitter Spaces session with Ford CEO Jim Farley.
I think it will not be cost prohibitive. It'll be, something that's quite affordable. In the hundreds of dollars range, it's an adapter, so it's not super expensive.
Look, Tom, this is such a fascinating story because at the end of the day, when you look at Tesla and Ford kind of combining, they are, at the end of the day, rivals. Ford trying to catch up with Tesla in terms of their EV scaling. So this one kind of caught me by surprise.
Yeah, it certainly seems like it's good news for consumers, right? Good news for drivers, because they do have that infrastructure. And this has been part of the shift, the spending, of course, within companies like Ford as they play that catch up. But they've also needed that infrastructure. I don't know about the US, but certainly here in Europe and the UK, it does still dominate. And there is that catch up amongst many of Tesla's rivals.
Yeah, you're already seeing that getting boosted a little bit. Tesla shares higher by 0.5%. Ford, I believe, also moving on that story. So certainly some stocks we're going to be watching there. A few more I want to put on your radar, though, especially in the chip maker space. Look, we're a day out after that blockbuster move from NVIDIA shares. And you can see it is still kind of up there. 380 around is where the stock is trading, down about 0.2% in the pre-market at the moment. But look, some of its rivals, Intel, for example, which took a little bit of a hit yesterday, higher this morning, trading higher by about 0.4%. Advanced Micro Devices in that same boat, higher by about 1.2%. But the AI theme continues throughout the tech space, specifically with Marvel Technologies. And this is, for the record, not the company that makes those superhero movies, Tom. This is Marvel Technology, the ticker MRVL there, trading at about $57 a share, kind of doing the same thing that NVIDIA did. They are seeing that their 2024 AI revenue is going to double, pushing those shares higher by 16% in the pre-market. So that's your chip stories there. We're going to be monitoring that throughout the day. And of course, Gap could talk about the other side of the spectrum, the perhaps more cyclical consumer nature of the spectrum. Gap shares rising as well. Essentially the hit that we expected them to take, not that bad. In fact, they're recovering faster than expected. Those shares, GPS is the ticker, higher by about 12.5% in the pre-market, Tom.
Chrissy, I'm glad you offered that clarity because I wasn't quite sure. Yeah, Marvel the comics or Marvel the tech and AI, and it's the AI one that we're focused on. It is important. Thank you. Right, coming up, U.S. Treasury cash balance shrinking to below $50 billion. More on that next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
While inflation is still too high, there are some promising signs of moderation, and I believe that we may be at or near the point where monetary policy can pause raising interest rates, and this will provide an opportunity to more fully assess the impact of the actions we've taken to date.
That was Boston Fed President Susan Collins speaking yesterday in Rhode Island. Joining us now is Bloomberg International Economics and Policy Correspondent Michael McKee. Look, the default worries intensifying, the Treasury's cash balance dropping to its lowest level since 2021. What are your takeaways here? Why do we care?
Well, the interesting thing about the Treasury cash balance, as our colleague Kaylee Lyons pointed out, 24 people on the Bloomberg rich list have more money than the Treasury Department right now. So they are very short on cash, and it does mean that they're going to have to, by June 1st, either temporarily punt it down the road or raise the caps by the debt ceiling by then. They've got $101 billion in various payments, including some Social Security and Medicare due on June 1st, and they got 49. So the math doesn't work. Yeah. But the question is, do they at this point feel a sense of urgency? The old saying, nothing concentrates the mind like a hanging, might come into play here.
Can we just point out that you're wearing dollar cufflinks? How appropriate for the debt ceiling debate?
Yeah, trying to keep up.
with the Treasury. Mike, talk to us a little bit about kind of what happens after this deal if it is passed. What happens when it's passed? What kind of effect does this have on the actual economy?
Well, that's an interesting question that hasn't been really focused on, because we've all been worried about what happens if they hit the debt ceiling and go over it. It looks like maybe they're not going to, so then what does this budget deal mean? Well, we don't have all the details, but basically it doesn't mean a whole lot to the economy, because they're only talking about non-defense discretionary spending, and not all of that is included. They're still going to be spending money on veterans programs. Defense spending is going to go up. The entitlement programs are still going to go up, as they automatically do. So it's going to have a very marginal effect, if any, on growth. And you always have to ask in these situations, growth compared to what? The baseline from the budget that was passed last year, they're not going to go down all that much, and it's going to be over a period of 2 years. So you really don't expect much to happen to the economy because of this.
Mike, does a deal, if it comes to pass, does it clear the way? Does it clear the path for a June hike from the Fed?
You could argue that both ways, Tom. The feeling had been that if they hit the debt ceiling and went over it, and we were in a default kind of situation, that no, the Fed could not raise. But if they do pass it, then the question becomes what happens with inflation? And it's, of course, a good question to bring up today, because we get the PCE inflation numbers coming up in just a couple of hours. And despite what Susan Collins said in that sound just before I came on here, we are not seeing any progress anymore. We had seen progress, a lot of it, in bringing down inflation. But if you look at the forecasts, we're not going to see much, especially in terms of the PCE core. It's not moving down. It's kind of stuck, sticky inflation there. So the question is going to be open for a while, up until the 14th of June when they meet again, as to whether they raise or not. Something to keep an eye on.
And Mike, more broadly across this US economy, the resilience of the labour market, we saw that again with the revisions around the jobs claims yesterday. Are other areas looking more vulnerable, even as the labour market holds up?
We haven't seen a huge amount of vulnerability. We are getting to the point where companies are hiring fewer people. We don't know whether that's because they're preparing for recession or because they've finally found the workers that they needed. Because each month we're still adding more jobs than we need to account for new workers in the labor force. So at this point, we're going to be very interested in what happens next Friday to see if we do see a decline in hiring towards that level, or if we see any kind of increase in unemployment that suggests that maybe the labor market is loosening up and companies are preparing for worse times.
And of course, the economic data coming in at 8:30 a.m. today. Mike McKee will be all over the PCE numbers and the personal spending numbers. Bloomberg's Mike McKee, international economics and policy correspondent. We thank you as always. Folks, that is it for early edition. Markets a little bit sanguine today. Let's see if that changes when we get closer and closer to the opening bells. Right now, surveillance, though, is going to take you throughout at least what to prepare for, what to listen for over the weekend. Crossmark's Bob Dole, Morgan Stanley's Mike Wilson, and Megan Green of the Kroll Institute all joined the program, as well as I hear a guest from Formula One. Interviews you do not want to miss. Stick with us. More surveillance ahead. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue. He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
If you look at tech, it continues to reinvent itself over and over.
People are jumping on the stories that look sustainable.
The big picture here, I think, in terms of the economy, is it continues to expand.
There's no way, in our opinion, that the Fed is going to be easing financial conditions anytime soon.
I think they probably try to hold all year, but then next year start to cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bramo is away, so this show is going to be totally unhinged for 3 hours. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market just slightly soft and negative on the S&P 500, down a touch after AI went absolutely nuts yesterday, Tom, in the stock market.
Really historic day. I think Lisa really grabbed it earlier than I did. I mean, the scale of the move is extraordinary. Let's pause for a moment on that. A very important Friday here and some terrific guests coming up. The pros look at standard deviation jumps. It was a 4.4 standard deviation move. Jump up in NVIDIA. And what I was unprepared for, John, is you go to the MEMB panel on the Bloomberg and you look at the NASDAQ 100, and, you know, I sort of frame in my head, John, 25%, 27% of the big guys, gone. That's ancient history, like 6 months ago. Line them up. Microsoft, Apple, now NVIDIA, brand new, Amazon, Google, Meta. You ready? 51% of the NASDAQ 100. Never have I framed that, let alone said it.
Year to date, the NASDAQ 100 up about 27%, but some of these names, listen to this. NVIDIA, year to date, up about 160%. Meta, year to date, up about 110%. Great note from Michael Hartnett over at Bank of America this morning. The title, Bonds and Bubbles. He said 4% real yields popped the internet bubble, 3% pop subprime, 250 crashed crypto. The market is saying 150 basis points, Tom, too low to pop AI.
Yeah, well, to pop AI, I'm not sure where to go with that. I really haven't framed out in my head. Alec Webb in London, I thought was absolutely brilliant yesterday, John, on this NVIDIA AI stuff. What I will say is once we get beyond the debt ceiling, are we this weekend, then we go back to normal interest rate analysis into the June 14th Fed meeting.
So publicly, lawmakers are insulting each other still. The Democrats blaming
It's a bigger group of people that need to be sold, whatever the toxic brew they're doing this
You
weekend.
count the officials. I'll count the cash at the Treasury right now.
Yeah, please.
Treasury cash balance, latest data, a break of 50 billion. A break of 50 billion, a break below that level. So down from more than 76 billion just the previous day, Tom. So that number's come down. I get that it's lumpy, it can jump, it can fall, but ultimately you can see the trend. 2 weeks ago, from 140 in the middle of May, down towards below 50 billion.
As we get started on this important Friday, I'm going to go idiosyncratic on you. John and I have different launch pads, different screens that we use in the Bloomberg for equities, bonds, currencies, commodities. Out of left field, but I'm sorry, it's a number that sticks out like a sore thumb today. You mentioned South Africa yesterday, unwinding. It's like Dow 10,000, Turkish lira 20. That's a new thing. That's a weaker lira, given the electoral drama that you're seeing in Turkey.
Let's whip through the price action and move on from that. Your equity market more broadly on the S&P 500, negative 0.14% on the S&P. Yields come in just a little bit by about 3 basis points. The 10-year at the moment, about 378.28. A lot of focus on the euro, trying to stage a bounce and recovery. Yes. 107.35. Fact of the matter is, we got down to lows we haven't seen since March recently. Very, very close to breaking 107 in yesterday's session.
I looked carefully. We did not break 106 once, twice, 3 times, maybe today.
Maybe. We'll see if that dollar strength comes through. Bit of economic data coming up a little bit later. Look out for that. We'll get personal income, personal spending at about 8:30 Eastern time. Get a whole load more at about 10 a.m.
I missed that.
UMich sentiment survey coming out before you can enjoy the long weekend. Before we can enjoy the long weekend as well here stateside, Daniel Ricciardo coming up a little bit later. F1 driver Danny Rick.
More than that.
40 minutes away.
To the American audience that may not be familiar with this truly international name, this guy is a star, and it's his character. It's not just driving around. He did the same thing. They all started out at 7 years old. He was near Perth, Australia. He's Australian-Italian?
He is. Speaks Italian too.
Does he speak Italian?
I often thought that he might end up in a seat over at Ferrari. But maybe it's too late for that.
I think there's a lot of speculation about like what's next, but we'll get to that later. But this is going to be fun. This is a guy that's taken the brand further. Imagine that. I mean, he's a little bit like Michael Jordan in basketball. He's done more than just bounce the ball, drive the car.
He's a real personality. He will be the second best guest this hour. The first best joins us now. Bob Dole, CIO at Crossmark Global Investments. Bob, buddy, good to see you going into the long weekend. Let's start with that rip-roaring rally in big tech and AI. Is that something you're willing to fight right now?
No, not really. Look, into strength, you do trim and trying to buy into weakness. But look, the NVIDIA numbers were off the charts, and that carried the day for technology. My problem is everything else. The average stock year-to-date is down. The Dow is down year-to-date. Russell 2000 down. 8 of the 11 sectors down year-to-date. This is a very narrow and getting narrower market, and that's generally not healthy.
Bob Dole, within your history, do you have an analog? Is there another time that looks like this?
Well, we're not there yet in terms of either valuation or narrowness, but into the 2000 tech peak, there are similarities beginning to build. I hope it doesn't end the way that one did, but we've got to watch it carefully.
Yeah, I look, Bob, at the choices that have to be made, and you're going to make them over a 3-day weekend. You're going to reallocate into June. You're going to reallocate into a mid-year review, June 30. How do you reallocate in equities?
So what I've been doing, back to the first question, is into strength, continue to trim tech. And my biggest add in the last quarter has been financials. Those stocks have been decimated. I'm not trying to figure out, which community bank's going to make it, but the big banks that do not have asset liability mismatches, that have good credit, they were taken down big time too. So having added to those, I'm thinking there's more juice to come there.
Bobby, you're talking about some banks like JP Morgan with both the investment bank and a large presence in retail as well. Is it more specific, Morgan Stanley, Goldman Sachs? What names are you thinking about here, Bob?
JP Morgan, top of the list. Citicorp, Bank America, they're the kind of names I'm adding. Already own some Goldman and some Morgan Stanley.
When you look at the community banks, I mean, one thing to do there is an ETF, something like that, the Keefe, Bruyette and Wood Index or so. Do you suggest, instead of cherry-picking community banks, looking at a broad portfolio?
You could do that. Look, I don't think we're out of the woods yet. When the Fed raises rates from 0 to 5% in 13 months, there are consequences. We've seen a few. I suspect the banks are not out of the woods yet. So be careful how fast you go.
Talk to me about preferreds. It's fossils like you and me, Bob. We remember when preferreds were talked about all the time. I think it's much less so now. That extra dividend in preferreds, does it have value?
Yeah, I think it will as we get into, assuming we get into a more defensive environment. We have obviously had a period when both preferreds and yield stocks year to date have not done all that well. And that's because we're in an environment where interest rates have moved up. If we can go sidewise for a while and the market, the equity market kind of gets a little sloppy, probably preferreds and dividend yielding stocks do better.
Bob, what would you say to people who have missed out on this rally year to date and are starting to feel anxious about getting in and deploying capital? What's your advice to those people?
Well, first of all, have they really missed the rally? They may have missed the stuff that's up, but the average stock to repeat is down. I wouldn't go chasing a whole lot here. I still think economic weakness, mild recession is in front of us. I know that's a minority of people now, but earnings have not behaved themselves all that well. After a better than expected first quarter, you would have expected a lot of analysts to move their estimates up, and it's been spotty in that sense. And I look at my screen and the stock market's selling at 21 times earnings. So it's not like I'm getting a bargain to take on some of this I really don't know risk.
Are you still advocating for some form of cash position? And if you are, Bob, how big?
Yeah, look, most of my portfolios, I'm to be fully invested. I have some long-short portfolios where I do have some cash. When you can get 5% on cash and you're uncertain about earnings and your PE is over 20, having a little cash in your portfolio, whether that's the fixed income portfolio part of your portfolio or the equity part, I don't think is the worst thing in the world.
Hey, Bob, good to catch up. Good to see you. Enjoy the weekend,
Have
sir.
a good weekend.
Bob Dole, thank you, of Crossmark Global Investments. Talking about yield at the moment, 449 on a 2-year. Yesterday through 450, we had 10 consecutive days of yields rising at the front end of the yield curve. This morning we come back down by about 4 basis points, but let's call it 450,
Well,
Tom, again on a 2-year.
I know you're house hunting this weekend, John. 30-year bank rate. I mean, it's a moonshot. I can't count it right now, but it's up 15 days in a row. Let's guess, rounded up 7.15%. And we have just, yes, we've just exceeded the peak of March.
This happening in real time?
In real time. 30-year mortgage, we've just exceeded that peak in March. Mortgage rates are now, based on the bank rate, 30-year mortgage, higher than they were at the March peak.
We've said it how many times? If you got that mortgage 30 years at 3%, you're not letting that go, are you?
This is original. I don't think I can say in any other housing crisis we've seen this.
But I think the whole thing's original right now. Just look at the data that's coming out of manufacturing versus the data coming out of services. The distinction there is just massive. Manufacturing worldwide, Europe, China, US, screaming recession. The services, take a look at airlines. I've had a lot of people reach out to me in the last 24 hours about how busy the airports are going into this weekend. That doesn't look like recession at all.
I talked to my driver today. The Bentley was in the garage, and he said the Hamptons will boom this weekend. He's spending the entire weekend in the Hamptons. He said it's back to 2019.
I'm going to say something that's very foreign to people who live in New York. What is it about the Hamptons? What is it about?
I
just don't get it
either.
I don't get it.
No, you're correct.
The beaches are, I'm sure I'm going to offend so many people who have spent a lot of money
there's some
on
nice
houses.
beaches.
They're not that spectacular.
Well, you know, what do you
$100 million
compare 'em to?
for a house
Excuse me,
on a
guys,
beach.
this is a guy with 4,000 square feet in Capri.
You can go to Capri or Ischia, anywhere on the Amalfi Coast, and pick up a house, a villa that you can do up for, let's say, several million. Go and have a look at how much it costs to pick up a house in places like Southampton.
I was going to say a
Montauk.
shack.
We're talking 50 million, 75
John,
million
I can
for
see
what?
you, John. I can see you up the Hudson River, off to the refs.
No, thank you.
My friend Emily's running a grocery store.
Anyone who's thinking of doing that, just send me a message. I'll do this for free. I will construct a global property portfolio for you for the same money that you're about to spend 100 million on a place in Montauk. I don't get it.
John, what this could be, instead of Happy Friday, we could say Happy Tuesday. Come back from Memorial Day.
Go to the Jersey Shore. What's wrong with that?
Happy Tuesday.
Happy Tuesday.
Yeah.
Coming up shortly, Jeanette Lowe of Strategas on the debt debate in Washington. That's next.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. And another Republican may be gearing up to enter the 2024 U.S. presidential race. The Wall Street Journal reports North Dakota Governor Doug Burgum is planning an event on June 7th to make a major announcement. Burgum's a wealthy former software entrepreneur who was first elected in 2016. And Bank of Japan Governor Kazuo Ueda says the BOJ's balance sheet isn't necessarily in a normal state, given the bank's large holdings of government bonds and ETFs. Ueda also played down the importance of wages or any single economic data set as a trigger for change. This suggests his desire to hold on to policy flexibility, leaving speculators guessing about the timing of policy shift. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
At the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. The debt ceiling deadline closes in.
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling. They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
Speaker McCarthy and I have had several productive conversations. The American people deserve to know that the Social Security payments will be there. The Veterans Hospital will remain open, and that economic progress will be made, and we're going to continue to make it. Default puts all that at risk. Congressional leaders understand that, and they've all agreed there will be no default.
The President of the United States with a touch of happy talk going into the weekend. There will be no default. The latest news, the reality check, just follow the numbers. This from the Treasury cash balance going into the weekend. The cash balance dropping below $50 billion, according to the latest data. That's down from more than $76 billion the day before. The contours of a deal reportedly coming together based on the reporting of Justin Sink and our colleagues down in Washington, D.C. According to people familiar with the matter, the two sides have narrowed some of their differences in recent days. Negotiators, Tom, said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. We're not there yet, but we're getting closer, apparently.
And where are we at, too? And what the conservatives are going to say is, okay, we're there, but just as you said, the key phrase is 2 years, or maybe it's 18 months, maybe it's 3 years, whatever. But it seems like it's almost a collegial Band-Aid to not kick the can down the road, but to have a termination date out there. That's what I'm going to be looking for, is what are the termination dates out?
Ultimately, the consensus view is, Tom, we'll be doing this at some point further down the road, regardless of how much further down the road it will be.
I think we've done it 78 times or whatever since World War II. I can't remember the exact statistics. 1960, I believe.
Yeah.
But, you know, we do this every 3 or 4 years, to say the least. As you go into the weekend, 3-day weekend, long weekend, for politics in Washington, they will look at policy and the outcomes of it. Joining us now, Jeanette Lowe, Managing Director, Policy Research at Strategas. It is a Baird company. Jeanette, what is a distinction for you? What will you listen for this weekend?
So first, thanks for having me. So we do have a deal coming together, which is good news. There are still a lot of details that need to be worked out as you continue to hear that they've made progress, and they are, limiting the number of issues that still need to be taken into account and finalized among the negotiators. So it does seem like we are getting closer. We're definitely going to be looking at how this deal is structured. This is definitely smaller than what the Republicans initially proposed. They were looking at 10 years of discretionary spending caps. We might be more at 2 years. So how that's going to be structured is going to be important, I think, for the markets, because there is this anticipation that we're going to get some austerity out of this deal. But even if we don't get austerity out of this deal, we still think there's more fiscal austerity in the years ahead for the United States.
This is really, really important. You went right where I wanted to go, and this is literally the history you learned at Richmond and BU. What's the difference between our austerity and what, say, the United Kingdom is living? They seem to be drowning in an austere psychology. I don't see that in the last 8 or 10 years in Washington. I see, if it moves, spend it. Spend every dollar. What's changed?
So what we've seen is that, obviously the pandemic, you had extraordinary fiscal stimulus come into and that the government provided. And then obviously we've had inflation come on top of that. What's really been the key change now, because to your point, we have been able to just spend and cut taxes quite freely for the past number of years. But now that we've had interest rates rise so much, that is now increasing the cost of the U.S. debt. And so net interest costs for the U.S. are now increasing. We have seen historically that once those rates hit 14% of tax revenues, financial markets begin to impose austerity on policymakers. We are currently at 12.7%, and we anticipate that we will get to 14% by the end of the year. And so that is where we're really looking. That's going to start to squeeze the federal budget. So even if this deal is not particularly austere, which given the current contours, it doesn't seem like it will be, we are still looking at the fact that over the next couple of years, the policymakers still have a number of other times that they're going to have to come into play to think about how do they bring the U.S. fiscal budget into a better alignment to kind of handle some of these costs that they're dealing with.
Jeanette, can we just finish on the ex-date, the so-called ex-date? The Treasury doesn't have a precise idea of when that falls. We're all guessing here. They have some information about tax receipts. It can be very lumpy sometimes. How are you reading the tea leaves of that situation?
Right. So, I mean, I think all the negotiators want to operate off the fact that we have June 1st as the X date. Now, there always is a little bit of flexibility with that. Treasury wants to have a little bit of a buffer so that if we were to cross over the X date, you would still have maybe some cash to still continue to make payments before the Treasury Department would actually run out of cash. Maybe they might be able to make it to June 3rd, maybe not. They did put out an auction this morning that does make it seem like they might have a little bit more cash at the X date. But I think the more important thing is that the negotiators are focused on the X date. And if we were to cross it, we do think that would be quite a market jolt It would actually help get a deal if we still hadn't gotten one at the same time. But I think that the actual, loss of cash is less important than that X date right now, just for policymakers to be able to control their focus.
Jeanette, just to finish on that point, when they start to think about prioritizing spending, I think there can be some confusion between going through the X date and defaulting on debt obligations. They can be two different things. How do you think the Treasury will start to prioritize spending if we go through that date?
Exactly. It's a great point, because the big thing that we have been trying to focus on is the fact that this would actually not be a default if we crossed over the X date. Treasury, we believe, would prioritize making interest and principal payments on treasuries. This would be more about prioritizing spending and payments to bills that need to go out at some point. We still think that the Treasury would prioritize things like Social Security, Medicare, defense, but then it's about whether or not you pay some other federal contractors on time. So it seems more like what we would see when we have a government shutdown with trying to move payments around, but it's not an actual default on U.S. Treasuries.
Jeanette, thanks for clearing that up. Appreciate it.
Fabulous.
Just brilliant. Jeanette Lowe there of Strategas. That final point's a really important one.
Yeah.
There have been some conflation between going through the X date and defaulting, Tom. They're not the same thing. They don't have to be the same thing.
I'm really proud of what our team's done on this. Maya McGinnis has been with us, and now Jeanette Lowe. What she said in the middle of that interview, folks, tattoo it to your brain. She said we're moving from 12% to 14%. And the CBO, this is like the adults, the CBO, forget about the politicians, says in 2053, 38% of our interest expense, 38% of our taxes are going to go to interest payments. That's how out of whack this is. We're trying to get out to June or get out 2 years, as you just said. CBO says we're going to go from 14% of tax revenues to pay the interest bill to 38% in 2053. You and I are going to be on set in 2053. I'm going to be 20 years to that Austrian bond. And the interest math doesn't work.
I'll say this about that. Tom, the problem here is that we're becoming more like Europe, but without the nice trains. It's not pretty. It's not good. And once you get through this, it doesn't mean that the debt conversation goes away. There needs to be a real conversation about this. I think there's been a total failure of those who care about this issue out of power, forgetting about this issue when they come into power. And this is something that, Tom, that quite clearly needs to change based on the trajectory that we're on.
Certainly the recent catalyst was a medical event, a pandemic. Everybody can, look back on history. Books and books will be read. But we had this natural disaster. And now we got to come out and that and get back to the austerity Ms. Lowe was talking about.
And government spending some significant money worldwide off the back of this natural disaster, which makes me wonder, Tom, why there isn't a bigger willingness from governments worldwide to really get to the source of that natural disaster, to understand what was behind it, what happened. I'm still surprised by that today. The almost lack of interest to get to the bottom of that when it's cost global governments so much money responding to it.
I agree, and the question is, how do you prepare for the next disaster? And I don't hear much conversation about that right now.
Very strange, isn't it? A lot of distractions at the moment. Here's one for you. Equity futures on the S&P, negative not even 0.1% on the S&P 500. Great lineup this morning. Dom Constant of Mizuho on this bond market, on the Federal Reserve and the global economy as yields retrace some of the move of the last 10 days after going through 450 on a 2-year. This morning we're down about 5 basis points. Your yield at the moment about 448. From New York City, going into the long weekend, this is Bloomberg.
the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very